Okay, well, I'll just say this, that actually they put the salad out first, and then they serve the meal afterwards. So they actually are trying to cater to some of those concerns.
The salad?
Yes.
That's, okay. Equities on the S&P. We'll get back on track. Positive by 0.1% on the S&P 500. Yields here, TK, up a couple of basis points, 473.81. The jobs report, 25 minutes away.
Well, that's where the yield is right now. I'm going to look at the VIX, 18.63, and the equity market really like, okay, what's happened? Not much. Boy, do you not see that away from equities. Briefing us is always, we start strong in this Jobs Day hour with Nadia Lovell, Senior U.S. Equity Strategist, UBS Global Wealth Management. Nadia, I talk about the VIX at an 18-19 level. How are equities ignoring the bond carnage?
I don't think equities are ignoring it. I mean, you're seeing valuation adjust to all of that. You've seen the market pull back from its high, down 8 or 9% from the late July high. And so, but we do think that this pullback is healthy. Also, I think what's happening in the market is that we sort of been in this micro news air pocket, if you will, ahead of the earnings season. And so the earnings season should be able to provide some clarity on the outlook for corporate earnings. We do think that corporate earnings will start to inflect back up in the third quarter, and we should be able to see growth. So that could be actually a potential catalyst for the market.
Are we in a bull market, or with this difficulty, this emotion of the last month, have we reaffirmed some form of bear market trend?
We think that we're still in this bull market trend. I mean, the earnings, again, should start to re-accelerate. And reality is, like, it's normal to have a pullback. We're not even at, like, a 10% correction yet. And so I think that we've gotten used to, at least this year, driven by the rally in tech of the market being on this steep upward trend. But a pullback is healthy. It does take a little bit of a valuation fraud out of some areas of the market. And so in our view, the risk reward is actually looking a little bit better for the equity markets from here.
So are you buying?
We are. We will be legged into this, weakness, continuing to dip our toes into it, but be selective in the areas of the market. You sort of want to maintain that balance. And so we have a balance with some defensive exposure along with some cyclical exposure, as well as some exposures to some of the secular trends that are happening in the market.
Are tech stocks defensive or growth?
I would say I would put them in sort of in the middle, in terms of, like, yes, there are parts of tech that are quite defensive in terms of the software areas of tech where there's a high level of recurring revenue. So that's by some stability in the earnings. And of course, you have other parts of tech that are more cyclical in nature, whether it be semis or hardware. But we are also seeing some bottoming in trends there. So tech kind of, plays all different areas. But I think overall, how I would categorize the tech sector is high quality.
Well, the high quality there translates to free cash flow. And to me, at the end of the day, and with all the uncertainty described by the bond market, Ellen Zentner of another house, Morgan Stanley, says there's great uncertainty here in 23 minutes. Okay, Nadia, all that's great. But the only thing I can hang my hat on is free cash flow. Do you agree with that? That we're really back to Graham, Dodd, and Cottle analysis?
I think it's important to look at free cash flow in this sort of environment, and also, strong balance sheet as well as part of that equation, especially when you're in an environment where rates are likely to remain higher for longer. You also want to make sure that those companies are able to self-fund themselves and not have to dip into capital markets.
Nadia, can you give me a target here on SPX, or are you going to wait for a Monday announcement on that?
No, for next year, I mean, we're looking at 4,700. So we do see upside to the market from here. I mean, of course, we'll see what the job reports are at 8:30. But reality is, I wish that we would get out of this sort of twilight zone where good news actually becomes good news again and bad news is bad news. I mean, the fact is that the economy does remain strong. The consumer remains strong. And so hopefully at some point the market will start to appreciate that. And I think that the earnings season could be that catalyst to do that.
Let's finish there.
Yeah.
There is this question about how you trade around the jobs market. Some people don't want to. Some people say they don't, but do anyway. How would you, all things being equal, trade a good number? Is good news for you yet?
I think good news is good news at this point. I mean, in our view, we think the Fed is done hiking. I mean, as you've been talking about all morning, financial conditions have tightened significantly. At least in your interview with Daly yesterday, obviously, the fact that we've had this move in the bond yields does account for sort of additional rate hikes. So we're in that Bostic camp where we think that monetary policy is significantly restrictive, and so we would look to be positive and good news being good news at this point.
Where do commodities fit into this? We were talking about the deal in the shale patch, Exxon coming out with the biggest deal that they've done in decades. How much do you lean in, even after how much of a bid up we've seen on the heels of some of the weakness that we've seen over the past couple of days?
Yeah, I mean, we are still constructive on the energy sector, and we actually think that this pullback in oil and energy does give investors who might have missed it an opportunity to really dip into this well again. I mean, OPEC Plus remains quite committed in constraining supply, and we know that demand picture remains very strong. So we continue to believe that oil prices, Brent, is going to be $95 and sustainable into next year. And that free cash flow that you were talking about, Tom, it exists in the energy sector. Free cash flow leads or 10% strong balance sheets and the likes.
Quickly here, Nadia, I love what you're saying. I want to say good news is good news with you. But I got a 5.49% 3-month T-bill. I mean, I'm sorry, the siren call of money market funds in a short paper is a huge constraint still, isn't it?
It is, but we don't think that these levels of bond yields are sustainable. We do think that bond yields will trend lower from here. I mean, yes, a 10-year bond yield could remain in this 4 to 4.5% range, but the economic momentum that we've seen early in this year, we just don't think that will continue into the fourth quarter and into next year. So we are looking for the 10-year bond yield to come down towards 4% by the end of the year, and then trend towards 3.5% by the time we get to mid next year, as the Fed looks to cut rates.
So given what you expect, is the biggest risk for you a re-acceleration in the economy or a hard landing?
A hard landing is the biggest miss. The equity markets isn't really priced for that. I think most people are in that soft landing camp. And we also know when you do hit a hard landing, that has implications for earnings growth. Earnings tend to pull back, in the mid-teens into that sort of scenario. And so we want to see the continued strength in the consumer. Inflation is coming down. We don't want a re-acceleration in inflation. So we sort of want that Goldilocks scenario to happen over the next 12 months. But, time will tell and the data will determine.
It's what we always want, not too hot, not too cold, just right, Nadia. Nadia Lovell, thank you, of UBS on this equity market. Appreciate it, as always. Counting you down to the payrolls report, fantastic lineup for you. Randy Krosner, former Fed governor, joining us going into the number. We'll get some reaction from him at the other side as well. Jeff Rosenberg of BlackRock will give us his perspective too. Mohammed Al-Arian, I can tell you, with us here in New York City in the studio. He's going to catch up with us about 9 a.m. Eastern time to go into the opening bell and break all of this down. And then Secretary Sue, the Labour Secretary, or the nominated Labour Secretary.
I've lost track of that as well.
Hasn't been confirmed just yet.
Yeah, what was that?
I know. Tom, we don't have a speaker either, officially.
Yeah, really.
So,
yeah, exactly.
Step at a time. If you're just tuning in, welcome to the programme. We are positive here by 0.1%. Counting you down to that payrolls report, let's call it 20 minutes away. Tom, the number we're looking for, 170K.
170K, and again, you go over the wage dynamic, which, John, you often do there, and to see if that's going to break. But, maybe the worst outcome here is stasis, where we just get another middling report. Nobody's talking about that. We're getting drama here, drama to the right, drama to the left, and what's the damage to the bond market if it's just...
Was it B. Mosey in Lincoln this week who said slightly negative? Was that him, Lisa? I think he said. Someone said this week, one of our guests this week said slightly negative.
It's the best case.
Would be the best outcome for everybody. Slightly negative, not too much, on trend, slow down.
Yeah.
Just slows down the bond market, sell off a little bit. But it's good enough, it's decent, that you're not crying about a recession anytime soon.
For everybody to understand, Lisa can remember out about 1 week. I can remember out about 1 minute. Farrah's telling me things we did 4 months ago where he has a crystal clear memory of whatever it was. How do you do that?
I rewatch the program all the time.
My deepest sympathies.
And I take notes from the guests. I've always done that. Go through the transcripts. Done that forever.
Okay, I'm watching.
Which is why I remembered that Saudi America line that you used a long time ago.
How do you do that? I mean, I'm worried about F1 in Qatar this weekend, and I'm Tots Luton. Is it Luton? Is that how you pronounce it?
Is that what you're going to watch?
Tots Luton. Got
Formula One back this weekend?
Formula One, I believe, is this weekend.
Okay.
Maybe next week.
I have to double check that. It's next week?
I don't know.
All right, we'll get up to
I'm
speed on
rooting
that.
for Orioles Diamondbacks.
Isn't it
That's
Vegas?
really what I want.
We should be more sustainable. Amazon Business can steer us toward more sustainable products.
How did you know?
Doug's hat.
Huh. This is easy.
Sustainability. I feel good. What's next?
It's a car that runs on positive vibes.
I love people. Sustainability. Good vibes.
Amazon Business, partnering with enterprise leaders for smart business buying.
Names in global leadership are on Bloomberg.
The conflict between the US and China has escalated so much. This is one of my greatest fears, that the small nation is forced to suicide.
Bloomberg. Context changes everything.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Steve Major of HSBC, just one of the best in fixed income, had a tough year, Tom. Bullish on fixed income. It's not worked out that way with the sell-off continuing, but certainly getting an understanding of where he went wrong. And I think the explanation around it is really, really important. Traditionally, deficits don't matter. In downturns, they really don't, because people will buy treasuries. The point he's making, I think, is really interesting. It's difficult to get people to go out the curve for less yield when the data is still good and you're getting tons of bond supply, which is the point Steve is making.
I think the flow issue here is critical, but it also percolating into this weekend. And you really wonder, we were saying people can't vision out to 2024 right now. I really wonder the fiscal impact of this bond carnage that we've had. I've certainly underestimated it. And, you look at the rates of change in the Chicago, mathematics of what's going on. And to Steve's point, is it about the debt and the deficit?
Ramo's been asking for a real-time ticker of that, haven't you, Lisa?
I want that. I want to have an understanding of how much the interest payments are going up in real time as you get the 10-year yield climbing. And I know that sounds nuts, but at the same time, that's the reality of it. And if it sticks, the fact that the U.S. did not push out their maturities the same way that corporations and individuals did means they are sensitive to those moves in a much more meaningful way than anybody else in the market.
We've got a former Fed governor around the table who was just like, yes, I want that too. I want that too. He's going to join us in just a second. Let's get to the price action on the S&P 500, positive by 0.1%, about 13 minutes away, 12 minutes away now from the payrolls report. Yields a little bit higher by a couple of basis points, 473.60. What an ugly week crude has had. Could close down close to 10% lower on the week, down to 82 on WTI. Worst week, TK, going back to March.
This is our interview of this bond carnage. There's no question about it. I've said for years that out of Brown University, the gentleman from Chicago is our definitive financial economist, and that's saying something at Booth School with Lars Hansen, Austin Goolsbee, and Raghu Rajan darkening the door. He's a former Fed governor. On this jobs day, we're going to rip up the script with Randall Krosner. I am so honored you are here with us today. I'm going to steal from Raghu the fault lines of Randall Krosner right now in this bond carnage linked into our greater economics. This is Booth School 101. Let's steal from Raghu and the fault lines of the great financial crisis. What are the fault lines you see right now in this bond carnage?
So I think that's exactly the important thing to be focusing on, is what are the unintended consequences of this? Because we know that interest rates are going up because people are concerned that the Fed's going to keep rates higher for longer. The markets finally seem to have gotten that message.
Right.
And I think Jay Powell's been pretty consistent on that for a very long time, but the markets are now focused on that. And we have to look at, well, what are the consequences of this? You know, we've seen around the world that when interest rates move up very rapidly, sometimes people who have been hedging properly or have been involved in a lot of leverage when they've been trying to hedge get into trouble. And so we're going to sort of see this over time. One of the manifestations, obviously, was Silicon Valley Bank earlier this year.
Yeah, and that's a small bank. Let's talk about the big banks. We've had a constant message that everything's fine with the big banks. I don't buy it for a minute because I heard the same tune in July of 2007. On a tranche basis, everybody's focused, including the media, on the garbage of the tranches. I'm going to go with David Goldman, and I'm worried about price movement in the better quality, middle quality tranches. Do you people at Booth have a conviction that they will sustain and get through this carnage?
So I only speak for myself. As you know, at University of Chicago, every person speaks for themselves. So I can't represent other people's views. But I think it's very interesting to look there, because if you go back to the global financial crisis, it was exactly that it was when markets started to get worried about the top
tier stuff.
So the bottom quality, that had fallen out much earlier, but it wasn't until really the summer of 2007 that the top parts got in trouble.
I love catching up with former Fed officials, Randy, because they're no longer burdened by the shackles of responsibility.
The shackles.
They can just tell us what they think. Can you tell me what you think they're probably discussing on the committee after the sell-off we've seen in the Treasury market? How do those conversations go?
So you'll have different views around the table. You're going to have some people are going, finally, the markets understand what we're about, and they've got it, and that does our job for us to some extent, because the markets weren't believing them. The markets kept thinking, oh, well, you know, these guys, they say that they're going to hang tough, but you know, most people in the markets have only been there for 10, 20 years. And they don't realize that in the old days, the Fed really would hang tough. They've only seen what's happened really since the global financial crisis. But the traditional approach is that, you know, when the party really gets going, the Fed takes the punch bowl away. And they're willing to do that, and the markets are finally getting that. So I think that's the discussion. Are they getting it? And then the question is, are they getting it too much?
As a Fed governor, would you sit there in real time and dial up a colleague on the board of governors and have a conversation about what is developing? How does that work out?
So it's exactly that. So there would be things, issues that would come up, and we might have a small group meeting, or we might have just a one-on-one on what's going on. How do we understand this? Does this fit with our models, or is there something different here? Then we might have ask for a briefing from the staff about, gee, is there something new here? Should we be using alternative approaches? Most people ended up with the traditional approaches, but it was usually
Can you think of an occasion where things did really change for you, where you had to pick up the phone and say, this isn't right?
Oh, certainly in the starting in the probably August, September of 2008. That was really when things were not moving by the playbook, and we knew something was terribly wrong. It's like, we really got to work through this.
Do you feel like at this point you would change your view? If you were on the Fed, all things being equal, based on the pace of the move, do you agree with the Mary Daly view of things, that if yields do stay at this level, that will remove the need to raise rates again?
So there's the short run interest rate and the longer run interest rate. And obviously, we've been focusing more on the 10-year rate, which has moved up very dramatically because people have finally gotten the message that the Fed's going to keep interest rates high for a while. I think it really would depend on how the data evolve. I mean, we're going to get a very important number in just a few minutes. We're also going to get some more inflation numbers. And so you might want to move a little bit more if the economy continued to seem very strong, if the labor market continues to be strong, if we're getting a lot of wage pressure, because the 10-year rate does a lot, but it doesn't do everything.
This is a difficult time, isn't it? It's very uncertain, and all of the data points that people say matter so much are really pocked with a lot of uncertainty and revisions backwards that are perhaps not necessarily that accurate. So which data point is the most important? Which do you watch the most closely?
So I'd say, well, I'd go to two. One is the data points that we're going to be getting today, and the other are on inflation itself. And in particular, the core personal consumption expenditure index, not the CPI, because the CPI is too focused on housing. The PCE has a little bit less of the housing in it, a little bit more of sort of general services, and so that tends to tell you a little bit more about where inflation is going. So labor market and the inflation numbers.
You know, I talked to the president last night, and I said if Michael Barr has to step aside, Krosner would be perfect as a vice chairman for regulation. And I don't, I want to keep you busy here. Michael Barr's got to be worrying today through October about mark-to-market. Now, maybe it's a little bit away from your remit, but the answer is we've got this confidence, which Michael Spence has written about. OMG, we fixed it in 08, 09. We fixed mark-to-market. We have great transparency with our major banks. I don't buy it for a minute. Do you have confidence that the Fed has knowledge of the opaqueness between mark-to-market and the free-for-all of this bond market?
So they know there's an opacity there. Do they know the exact numbers? No one knows that. Precisely because
can they measure the opacity?
You can get a feeling for how much you don't know, but it's not like you can say, well, gee, we know that these are not being priced to market too quickly. You can't say, I know what that market price would be.
I got goosebumps. That was Grossman Stiglitz from a million years ago. What he said that's so important is you know what you don't know. That doesn't help you if your bond's moving from 82 down to 78.
We don't know the jobs report. We know that. Comes out in about 5 minutes. We'll find out what it is in just a moment. Mike McKee's standing by. He's going to break that down for you in just a moment. Off the other side of that, we're going to catch up with Jeff Rosenberg of BlackRock. In your equity market going into all of this, on the S&P 500, we're positive by 0.1%. In the bond market, we look a little something like this in the Treasury market. Yields, Tom, higher this morning by about 3 basis points on a 10-year, 474.85. Mike McKee, can you give us the tease for 5 minutes' time?
I think what we're going to see today is a bond market that's like a coiled spring for this. When you look at the whisper number, it's 189 right now, and the forecast is for 170. You noted that the 10-year yield is up about 3 basis points. Everything's kind of coiled to go higher if we get an upside surprise. And so that'll be the real story, not so much what the number is today, but how the bond market interprets it. We also expect the unemployment rate to go down a bit. So if that doesn't happen, there'll probably be some confusion for a few minutes till we figure out why, whether it was more people in the labor force or whether people are starting to get laid off. So it's going to be interesting to watch the reaction to this, even more so than the numbers themselves.
Mike, to steal from Randall Krosner of Booth School Chicago, you know what you don't know. What's your biggest mystery in this jobs report?
I don't know what I don't know, Tom. Actually, I think that one thing we don't know that could matter is the number of people who come into the labor force. It was over 700,000 last month, and that's what pushed the unemployment rate up. That's considered a good kind of move, but if we get a much smaller number, that could help the unemployment rate go back down again. We don't know what that number is going to be. Probably we have an interestingly wide range for the jobs report itself. Steve Stanley up there at 250,000. So that'll be something we don't know either. That'll be interesting to find out.
Randy, your final thought before we get this figure in terms of what you're looking for in the granular data, what you're trying to understand.
So really the key will come down to wage growth, because that's one of the key things. It's, you know, if you think about what the costs of production are, even for manufacturing, wages are and labor costs are a very significant fraction of that. And of course, in services, it's almost everything. And so if you think about where are the cost drivers going to be going forward, it's in the labor market and in particular wages that we'll be getting just in a few minutes.
What did you think of the forecast from the Fed a couple of weeks ago? Aspirational?
So as you know, people talk about hard, soft landing. Jay Powell's talking about softish landing. I've been talking about hardish landing.
Hardish, what's that?
That means that I really think that we can't get out of this without a substantial slowdown, possibly recession, not off the cliff. But I really don't think we're going to get out of this without a substantial slowdown. And I didn't really see that as much in the data or in their forecasts as I would have been forecasting.
Randy, stick with us. We're going to break this down in a moment. TK, the estimate, as you know, well by now, 170,000.
Halloween 2009, a 10% unemployment rate. This jobs report is important as the angst we felt at 10%. Completely different. It's about finance and bonds, not about the real economy. But I got to go back to Halloween of 2009.
Elisa, what are you looking for? Headline number 170, that's the estimate. Unemployment, looking for that to come down to about 3.7 from 3.8. Wage growth, average hourly earnings month on month, looking for 0.3 up from 0.2.
Honestly, I'm watching the bond market and its response, to quote McKee. I mean, honestly, to me, that's going to be the most interesting thing. If we get an upside surprise, does it get revised downward next month? We shall see.
Well, let's go through the price action for you, how we're set up ahead of all of this. I've gone through the numbers that we're looking for. 170,000 is the median estimate in our survey. Let's start with equities on the S&P 500, positive here by 0.1%. Heading.
Hi, Phil Swift here. This is Flex Super Glue. Just one single drop virtually welds itself to the surface and can easily lift over 3 tons. Get the new Flex Super Glue because it works.
Through 5% this morning, 490.34. Yields up on a 10-year maturity, up by a couple of basis points. New cycle highs earlier this week. The yield right now on a 10-year maturity in America, 473.81. With the labour market data, let's get to Mike McKee. Hey, Mike.
Good morning, guys. And the numbers are just coming out now. Unemployment unchanged at 3.8%. That's the first number we get this morning. Payrolls, though, wow, 336,000. Let me repeat that, 336,000. Change in private payrolls, 263,000. Remember, ADP said 89. The change in manufacturing payrolls up 17,000. And for the months of July and August, we've got a revision of plus 119,000. So the labor market considerably stronger than people thought. Average hourly earnings, Randy was worried about that, just up 0.2%. That's much lower than anticipated, same as last month, which pushes the average hourly earnings on a year-over-year basis to 4.2%. Labor force participation still at 62.8, so not a major concern there. And in terms of the establishment data, leisure and hospitality still the leader, 96,000 jobs during the month. Government employment increased by 73,000. Now, there were questions about the seasonal adjustment for teachers in August, and so that may be a bit of a payback there. And I'll have to look up, well, here we go, transportation and warehousing up 9,000, truck transportation adding 9,000 jobs. Remember, we lost 37,000 in August when Yellow went out of business. Looks like about 9,000 of those reabsorbed. I'll go through this. You guys check out what the bond market is doing, because this is sort of the mother of all upside surprises.
I don't need to check, Mike. You can already guess. Mike, thank you. The sell-off resumes. Slow down. What slowed down? Major upside surprise on the headline number. This is a knee-jerk reaction. It always is. Let's see if it sticks, but I'll give you the price action right now. Equities down hard by about 0.7% on the S&P 500. Let's slice and dice the bond market for you. 2-year, 10-year, 30-year, 2-year up by 6 or 7 basis points to just short of 5.1%. 10-year high by 7 basis points to 4.79. 30-year had a look at 5% earlier this week. We're heading back towards it, up about 6 basis points right now to 4.95. Once you've guessed where the bond market's going, you can assume where foreign exchange is. The euro breaking down against the dollar, just about holding on to 105. 105.20 on the euro against the dollar. TK we're negative by 1/3 of 1%. I'm going to say it, Tom. It's early days. I know it can change, but good news was just bad news maybe for this market, Tom. At least for now.
I'm not going to insult Randy Krosner with the good news, bad news silliness. What I'm going to look at is a 2 standard deviation move up in the inflation-adjusted rate. And John, I just can't say this enough. I go to a real rate analysis. We'll do that with our great team of people. Commercial free for you in the next 28 minutes. Michael McKee takes a second look at the impossibility of 18 pages of data. Mike, what do you see?
Well, I'm looking through where we found jobs. Construction's still adding 11,000 during the month, so the builders are still putting homes in the ground, and they're still looking to find people. The manufacturing jobs I mentioned earlier, 17,000. There have been questions about what would happen, but the ISM number earlier this week suggested we would see an increase, and we do. Retail adds 19,700. I don't need to do the point there. And professional and business services adds 21,000. That was a big category of gain in some of the earlier numbers this week. So it's interesting that we see that follow through. It's an area where if you're adding jobs, it's a suggestion that maybe companies are still looking for more. So it looks at this point like the overall number is solid, and it comes from a lot of different categories, not just hiring in one or the other.
If you were hoping to get away for the weekend, stick around. I guess you've got no choice now. Stick around for the next hour on Bloomberg TV as well. Coming up at the Open, Bloomberg's opinion columnist Mohammed Al-Erin and president of Queen's College, Cambridge, Mike Collins of PGIM Fixed Income, Victoria Fernandez of Crossmark, plus reaction from the administration in Washington at 9:45 Eastern Time. We'll hear from the acting U.S. Labor Secretary, Judy Su. TK, this market down by about 1% on the S&P.
Let me do a data check here as we get to Governor Krosner here in a moment, and that is I'm going to give you a 5% 30-year bond in moments, 4.99% right now, 10-year. We've got a new initiative here to a higher yield, lower price as people consider Michael McKee saying that this job report was across many, many different sectors. It was not a dysfunction or singular or that. Randy Krosner with the Booth School, Chicago. Randy, I'm going to go from a nominal to a real rate analysis. Let's go back to first principles. I never framed a 2.50 10-year real yield. Why does the real yield matter, and how will that new high real yield change our listeners and viewers' lives?
Because ultimately it is the inflation-adjusted rate. It's the real rate, you said, that matters for thinking about what investments firms are going to be willing to make. Because if prices are going up and they can input prices are going up, that's one thing. But if you adjust for the inflation, so you take out that changes in cost and changes in prices on both sides, you've got the real yield. And if that's going up very significantly, that means that firms are going to be less willing to invest. Are they less willing to hire? We've also started to see real wages grow, which is great for workers, but that's probably at some point going to mean a little bit less demand. Obviously not right now.
Well, that's where I wanted to go. What's your reaction as a former Fed governor to this report that is not only a massive upside surprise, almost twice as much as what the expectation was, but also with an upside revision to the prior month? What would you, if you were still on the Fed, do with this?
So I think look at two pieces. One, obviously the incredible strength of the labor market continuing to be there. But the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that in a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks. I find it hard to believe. It's possible. After being at the Fed during the global financial crisis, I never say never about anything. But we've never seen something so perfectly Goldilocks before. But if you can have a strong labor market but not have real wage growth being too high, that would be ideal for the Fed.
One thing that I'm seeing is the underemployment rate coming in a little bit, 7% from 7.1%. It goes to the Priya-Misra question, which would lead to a higher neutral rate longer term if we get an increase in productivity, if we see some sort of just general growth that means a higher inflation, higher growth kind of era. Are you hearing anything, seeing anything in this data that suggests that has a greater likelihood than you previously thought imaginable?
Well, not in the data today, but we have been seeing some pretty good numbers related to productivity growth. And ultimately, that's what we want to see. Higher productivity growth is great for economic growth and great for real wage increases for workers. Now, whether that's just sort of a one-off thing, it's going to take a lot more data to figure that out.
Tell me at the Booth School, is you people own the high ground on the analysis of our finance and to say one emotional thing, commercial real estate. The fact is, in the carnage that we're in right now, 30-year bond, 4.98%, we're going to have a normal American failure of restructuring, failure of businesses, new fresh money will come in and, at a lower distress price than that. Will we just survive this event, or can there be lasting damage here like there was in 07, 08, 09?
So I think we really need to rethink the business model of how this is financed, because a lot of small and medium-sized banks have a lot of exposure in this area. the chickens are going to come home to roost because interest rates are a lot higher, so refinancing rates will be higher. There are a lot fewer people going into the office, so a lot of the commercial real estate values are going down. And I think a lot of the small and medium-sized banks are going to be stepping away from this. So the question is going to be who will be financing this going forward. The big banks don't seem to have any appetite to do that. Maybe it'll be new players like private credit coming in, but that's very new. We will have to see.
But the heart of the matter here, Professor Krosner, is for the fossils like me, the collective memory of our youth of continental Illinois, out of nowhere. What are the shadows right now that you see of a continental Illinois, of portfolio insurance in '87, the leverage of '98? What's the Krosner shadow right now you're most focused on?
So I do think trying to understand what's going on with commercial real estate, how that's going to affect small and medium-sized banks is very important. And then also looking through, trying to look through into the areas we don't know about. This gets back to what we were talking about before, into the non-bank financial sector. So we've got a lot of data about banks.
Right.
But just as I was describing, there are a lot of non-banks who are doing traditional bank functions. We don't have as much insight into that. So that's something that we know we don't know, and we have to find out a lot more information
That's
about
another one-hour conversation with Professor Krosner. We'll do that at another time. We are honored you're with us today. For all of us at Bloomberg, thank you so much. Randall Krosner of the Booth School, Chicago. We're also honored that Jeffrey Rosenberg could dart in the door. He was just looking at his Bloomberg terminal. Jeff Rosenberg, let's take this all-in non-farm payrolls. I have the number here, 455,000 with revision. Take that shock into your shock of working at BlackRock this week in fixed income. How do you dovetail the two?
Well, I think I'm gonna talk about something that we usually don't talk about on Payroll Friday, and that's third quarter earnings, which begin to kick off. And what this payroll report really, I think, starts to reconcile is a disconnect that we've been hearing between kind of the bond market consensus, soft landing, inflation, slowing labor markets, and at the same time, a very positive corporate profits, margins holding up. And here's the problem with those two stories is that how do you get the slowing in labor? How do you get layoffs if corporations are doing just fine with pass-through and with margins? And so the reconciliation of those two inconsistencies is on display right now. This is a much stronger labor market, clearly. That's what we see in the report today across the board. And so the challenge is, and what you were relating to with Randy Krosner, is that this is an environment where rates are going to have to stay higher for longer, potentially even go higher. And the longer that occurs, the more those cracks and that vulnerability has time to eventually show up. But this is really telling you something that the equity markets have been telling you, that it's good for corporations, good profit margins, good earnings isn't a good story for labor market normalization and for the inflation story.
Jeff Rosenberg, Mr. Fink's office called me this morning as I was coming in, and they said, don't ask Jeff Rosenberg anything about inside baseball at BlackRock. I will not. But I will ask you about the functioning of our fixed income market off this shock report. Are there instabilities visible outside of BlackRock that you see? Can we get transactions done as we get ever higher yields?
It's been a remarkably orderly move higher in terms of market functioning.
Agreed.
In terms of liquidity. I think the issue that you, again, just went through with Randy about where are the cracks, where are the vulnerabilities, and Randy highlighted, the change in intermediation. The financial system is much more disintermediated today and in different ways that we haven't seen before. And so the story and the history is that as you have these shocks in terms of interest rates, there are vulnerabilities. The challenge is this time will be different in terms of where those vulnerabilities show up, and that will be surprising. I think the key here is that coming off of over a decade of zero interest rates, we established a lot of expectation for the persistence of low interest rates. And yes, there's a lot of liquidity still left over, private credit, dry powder. The issue isn't the liquidity, it's now the cost of that liquidity and whether or not you can afford those much higher interest rates. I think the thing to be aware of, however, is that in the private credit market environment, you don't have the same kind of liquidity triggers that you have in the banking sector. You mentioned continental Illinois. You don't have deposit runs. So you have a lot more flexibility to extend the time period, a lot more flexibility to limit any kind of spillover shock risk. So it functions in a different way, but it doesn't mean that there isn't still eventually the cost to be paid for a much higher interest rate environment.
Right now, as you talk, we are seeing the markets break down in a pretty significant way. We're seeing that 30-year yield climb back up toward that 5% mark, 4.98%. You could see 10-year yields climbing back up near the highs that we saw earlier in the week. 10 basis point move. Yeah, really just a moonshot, 4.82%. It's coming in, it's going up. It's definitely a volatile morning. The euro going down to 1.051. So you could see it just flirting with that 105 level. Jeff Rosenberg of BlackRock, I am curious from your vantage
rates at high levels, but doesn't necessarily have to go further. That's already in the price. And when you look at the back end of the curve, yes, there's more vulnerability. Yes, we still think there's more term premium steepening to go, but you're starting now, just finally, to get to levels where you're getting back to normal. And that movement from abnormal to normal is very painful, but where you're getting closer, and that's interest rates that approximate nominal GDP. Right. That's the history of where the long-term interest rate should be, and you're getting closer to that. You may overshoot, and you may have more term premium risk because of the deficits and QT, so we're a little bit cautious on the back end, but why would you buy bonds? Right. You may not want to buy bonds like 30-year bonds, but the front end of the curve is really starting to get to levels that are much more attractive.
For 2007 and on, this is one of the historic days we've had on Bloomberg Surveillance. We welcome all of you commercial-free here through the hour. Michael McKee with us, Jeffrey Rosenberg of BlackRock, Ira Jersey scheduled to be with us as well. On the data check front, equity markets somewhat quiescent. We're out a stick on the VIX, 19.46, and basically a 1% move in the Dow. The Nasdaq, SPX does fractionally better. SPX is down 0.8% as well. I can't say enough about the moves in the bond market. If I keep talking, Lisa, we're going to get a 5% print on a 30-year bond. I can round it up right now. We need to get a reassessment of this historic jobs report, 455,000 with revisions. Michael McKee with one more insight.
Well, it's a fascinating number, Tom, because nobody expected it that high. Steve Stanley was by far the highest on Wall Street at 250,000. So it does show that people are still looking for workers. Now, the question is, when you have a number like this, how much of a drop-off are you going to get the next month? Or are we going to keep this sort of thing going? Some of this may be payback for numbers that were a little odd last time, like the yellow trucking went out of business and subtracted 37,000 jobs, 9,000 came back, so we don't get that effect again. And there obviously was a seasonal adjustment issue with education because we got 40,000 additional folks in education during the month. But it's still a very, very strong number. Now, the interesting thing I take away from this is that with the 10-year note yield headed to wherever Tom drives it, does this mean that the strong number pushes Wall Street to reprice for yet another Fed move, or is this the Fed move? When you go back to Mary Daly yesterday saying that the market yields rising had the equivalent effect of another 25 basis point increase. Does this mean the Fed has to move or not? And I think a lot of that probably comes down to next week. The CPI numbers that we get, if the inflation rate is still going down and we didn't see a big wage increase here, then it's okay to have this kind of job growth.
Right now, definitely the bond market is speaking, and they are doing a lot of work in terms of tightening financial conditions. I'm also watching the euro breaking down below 105 now, 104.99. Jeff Rosenberg of BlackRock still with us. And from your vantage point, is this the one hedge that has worked in this period of turmoil? Buy the dollar.
Yeah, it's been pretty much rate driven, and I think as you're highlighting this morning, that rate move is reflective of the move in the dollar is reflective of that rate move. I want to go back to what Mike McKee was just saying in terms of the Fed, and I think that is what you're seeing in terms of pricing in the last hike. And I think also as well, they will recognize that the market is doing a lot of the work for them, and we're going to get the tightening in financial conditions. And they were hoping to avoid an easing of financial conditions, which is what they've gotten here. So I think that helps to kind of move us off of the Fed tightening path. The real issue in terms of the bond market pricing into next year is we've priced out about half after the FOMC, half of the cuts that were priced into next year. And I think that's the next move that you can start to see is really pricing out the cuts as you get more of this higher restrictive for longer kind of perspective.
And we did see that 30-year Treasury yield across that 5% mark just briefly, but flirting once again with that level. Jeff, how much is this a sustainable rate? You said pricing out cuts going beyond 2024. Is this sustainable economically and from a risk asset perspective?
Well, a lot of that depends on this projection in terms of the inflation trajectory, right? So the reason for the cuts priced in, or one of the reasons for the cuts priced in by the bond market is the expectation that inflation starts to fall, and the Fed wants to cut rates so that, you were talking about it earlier, Tom, not having real rates go up as inflation goes down. So is it sustainable? Yes, but a lot of that's going to go, and Mike McKee, you hit it on the head, next week in the CPI report. It's a very strong jobs report. A big component of the inflation expectations declining is that core services ex housing, which is really related to the jobs market. So good news here so far is AHE, average hourly earnings, not ticking up. As long as you see that inflation trajectory go down, then I think you can get that pricing in the second half of next year.
Jeff Rosenberg,
it's very much dependent on that inflation.
Jeff, I want to go to you with one more important question. Stay with us, and we're going to bring in Ira Jersey right now, Bloomberg Intelligence. Moments ago, folks, we have a 30-year bond of 5.01%. Lisa will tell you what the bank rate 30-year mortgage is going to set at on Monday. Who knows? So we have Ira Jersey and Jeffrey Rosenberg to get us to the next hour. Dr. Alarian will join Mr. Farrow here in the hour. I'm thrilled to tell you Paul Sankey will join us on Exxon Pioneer on Bloomberg Radio here in a bit. Jeff Rosenberg, I want to cut to the chase. I've got a multi-standard deviation move in price in a blended bond index like the Bloomberg Total Return Index from the peak of the market in January in 2021. How do you frame out, Jeff Rosenberg, that institutions, retail, and retired America will somehow get back to the pricing of the great moderation? You must be looking at in years.
Yeah, and I'm not sure, Tom, the framing is that we're getting back to the pricing of the great moderation. And I think that's part of the adjustment here is that you may not have that bond market that you were used to in terms of an upwardly sloped yield curve, falling interest rates, a high positive total return, and most importantly, a reliable ballast to your stocks. It's a very different bond market, and this is the transition period, and I think investors have to really recognize that. And so the opportunities are really changing how you hold your bonds in your portfolio. It's much more in the front end. It's much more about flight to quality. Insurance is no longer the 30-year. It's the front end of the curve. It's a steepening when you have a crisis because you've got that rate possibility priced back into the curve. So a lot of changes in thinking about how we build portfolios.
Jeff Rosenberg, thank you so much for taking the time on a day that truly is historic, as Tom was saying. Just looking at the 30-year yield right now, we are seeing on an intraday level the highest rates going back to August of 2007, solidly through 5%, 5.02%. Ira Jersey, Chief U.S. Interest Rate Strategist of Bloomberg Intelligence, joining us. And I've got to say, what a moment. Is this being driven by sellers or by a complete lack of buyers who have no conviction at a time when the U.S. economy seems to be running hot?
Well, today has to be sellers, just because you wouldn't expect a lack of buying to generate a 10 basis point move in the long end of the yield curve. I agree with a lot of what Jeffrey said. I think the thing that we have to think about here is who's going to be the incremental buyer going forward. And when you have the global rate environment changing so significantly with positive yields in jurisdictions like Germany and Japan that had more than a decade of negative interest rates, now there's alternatives to just people buying treasuries. So I do think that we have shifted the demand dynamics, and we need more domestic involvement, and we've seen that over the last year. But that's also come with yields rising pretty significantly.
I got to say, Ira, I'm looking at something close to a 20 basis point move in a 10-year yield as it pushes up toward 4.9%. Is this healthy? Is this okay?
Well, liquidity in the bond market has gone down very significantly as you have new regulatory environment that's changed the way that the bond market trades on a day-to-day basis. So I think when you get moves that seem pretty large like this, one, are they fundamentally driven? The answer to today's move, I think, is yes. But then they just get pushed out even further than you would expect on if liquidity was decent. You don't have the leverage in the system you used to have, so you don't have levered investors who might say, hey, I'll take a punt, and if we sell off 20 basis points, I'll try to clip 5 basis points going the other way when the market gets oversold. You don't have those people anymore.
Ira Jersey, you have so much perspective on this. Just thrilled to have you. And folks, I can't tell you enough about our team putting together Krosner, then Rosenberg, and now Ira Jersey. The market's walking away, Ira Jersey. There's no other way to put it. While you're talking, we're out to a 503, even 504 10-year. I've got a 30-year, rather. I've got a 10-year yield back to the summer, pre-August, third week of August of 2007. And if I look away and have some tang, I got the 10-year real yield out to 2.56%. Ira Jersey, you and I know, as Chris Whalen talks about, there's a point where there isn't somebody on the other side of the phone. Price down, you need to get rid of it, and you can't sell it. Are we anywhere near that analog?
Well, I think we're close depending on who you're talking about. And, I think your real yield point, Tom, is really interesting because with TIPS yields heading back, it seems, toward maybe 3%, at some point there's going to be value seekers in the markets. And we're just not quite at that kind of level yet, particularly with the repricing of how long the Federal Reserve is going to maintain rates at the peak. November almost doesn't matter. Even if the Fed hikes in November or doesn't hike in November, it's really, do they not then cut until 2025 or maybe even 2026?
Right.
So that's been one of the keys, I think, for the market here in the adjustment is, does it make sense to buy a 10-year yield when you can buy a 2-year note or a one-year T-bill well above 5%, and you think that you're going to be able to get that for the next 18 months. So it doesn't make sense to buy the long end if you get a better risk-adjusted return in the front end.
To the idea of the never of this October, Lisa, he just said it. I've never framed a 3% real yield. That was something from another, I don't think I had gray hair. It's from another time and place. What Mr. Jersey just said there, a 3% real yield. You tell me how Business America operates.
They are going to have to grapple with that. We're looking at right now close to 2.6% in terms of a real yield on a 10-year. So it's really moving in real time. Ira, I want to go back to something that Priya Misra said earlier in the show, talking about how banks are one of the biggest buyers that have stepped back, that basically are no longer hoovering up U.S. government debt. How much is this one of the main features, aside from China, aside from Japan, that really is one of the big drivers at a time when they used to reliably be a base for the U.S. government?
Well, so really, banks are not massive holders of all of the outstanding Treasury securities in the country, but they are one of the incremental buyers, right? So banks will step in, and they have a choice of whether or not to make a loan or buy mortgage-backed securities or buy Treasuries. And owning some Treasuries is something that they have to do now because of the regulatory changes that went in about a decade ago. So banks are always going to be regular buyers. I think that at this point, banks have alternatives to what how they can manage their portfolios and manage their regulatory risk. So they can own a lot of reserves, right? So the Federal Reserve has kind of created this dynamic where banks don't need to buy as many Treasuries yet because of what's going on with their reserve balances.
Ira, a busy day of publishing for you and Bloomberg Intelligence. Thank you so much. Ian Ling and BMO Capital Markets looking for 5% 10-year yields on the horizon and does speak to the instabilities it will bring to the real economy. Our instability is to ask one final question of Michael McKee, who actually knows what he's talking about.
Oh, I wish I did, because somebody asked me, why did economists get this wrong? I said, I don't have a good answer right now. I'll I'll have to look into that. We've just underestimated all along the strength of the U.S. economy. And when I say we, I'm including the Fed in that. And so it does change the game a little bit if we continue to see this kind of strength. 266,000 average each month for the past 3 months. That is not an economy that is going into recession. Takes that off the table. But the good news is average hourly earnings did not rise very much. So if CPI comes in soft, then how do you position the bonds?
Our final guest for the morning is Lisa Abramowitz, because this is her wheelhouse. The heart of the matter of Lincoln's note, of Rosenberg, of Jersey, of Krosner is your world. How do we move from a full faith and credit analysis out into credit, into stress? What do you think will be the ramifications?
What we already have seen is the worst period of time, the worst sell-off in credit going back to March when everybody was worried about a banking system collapse. At this point, this is where we start to see people worry about refinancing risk 1 year out, 2 years out for some of these high-yield companies. When does this become a sort of self-killing cycle where these yields have to come down because something breaks? I don't know the answer, and I don't think anybody does.
An historic moment for the financial markets. Please stay with Bloomberg Television and Bloomberg Radio through this morning. El Arian with John Farrow next.
Well, apparently good news is bad news, and really, really good news is really, really bad news. Live from New York City this morning. Good morning for our audience worldwide. Yields absolutely surging. Equities taking a dive. We're down by more than 1% on the Nasdaq. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, the jobs report delivers a major upside surprise. Detroit's Big Three bracing for a UAW update, and Exxon closing in on its biggest deal since '99. We begin with the big issue, payrolls in America.
Look at what's happening with labor.
Today's data on jobs.
Non-farm payrolls. You do need to fold that into some of the other data we've seen.
That consumer and that labor market is something that we are very focused on.
Our economy is really being well supported by two things.
The very tight labor market.
Resilience within the labor market.
And the consumer.
Consumers are still out there spending away.
Until that stops, I think we're in higher for longer.
The Fed wants the labor market to slow.
This slowdown is coming with the economy.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
We will be watching, though, the unemployment rate and labor force indicators beyond just the payrolls print.
It's all about the consumer, and it's all about the labor market.
It's all about the labour market right now. With us to break it down, Mohammed Al Erin of Queen's College, Cambridge. Mohammed, let's get straight to it. Your thoughts on that one from 31 minutes ago?
I had three reactions, John, two of which you covered in your introduction. One, this is good news for the economy right now. The fact that we can deliver over 400,000 jobs, if you include revisions, without earnings pressure is good news. It is, secondly, bad news for markets and for the Fed. The Fed is not going to welcome this report, which leads to my third issue, which is over the long term, this may end up being bad news for the economy as well.
Well, let's break that down piece by piece and jump to the Fed piece of it. From your perspective, Mohammed, as you look at the move in Treasuries this morning, and let's break it down together, 2-year yield higher by more than 10 basis points, 10-year up another 15 basis points, and briefly at cycle highs, fresh cycle highs just moments ago. Is that the market doing the Fed's work for it, or are you expecting more from the Fed because of these numbers?
So if this were not a data-dependent Fed, and how often have we heard this, we are data-dependent, which is always strange to me, because you are acting with tools that have an impact with a lag. But given how often they've said this is a data-dependent Fed, yes, it puts back on the table a hike for the 1st of November, which means that market now are not just having to internalize high for long, but higher for longer. And that is the problem. When you fall behind right at the beginning of an inflation cycle, you pay the price when you get to the last mile. And that's what we're doing right now.
A three-part story for you then, Mohammed. First of all, the data's good for the economy. Secondly, it's bad for the market, but ultimately that could be bad for the economy further down the road. You wrote for the FT earlier this week, the US may no longer avoid recession. How do these numbers play into a call like that?
Unfortunately, they are consistent with that call. Look, John, this is an economy that got used to ridiculously low interest rates and got used to liquidity injection. The change in the regime is happening really fast. So something is likely to break, probably in the financial markets, but that will have spillback into the economy. Then there's a second issue, which is just as important. This economy has to deal with a whole host of other things, the most important of which being that it is the supply side that's a problem, not the demand side. And unfortunately, that realization is not fully yet comprehended by the policymakers and by the markets.
Jason Furman weighing in this morning and on Twitter. I've shared that view with you all. First reaction to jobs numbers, shock. Second reaction, nervousness. Further reflection, this could be quite good. Went on to say 336,000 jobs, participation's high, wage growth's moderated. We could be in the middle of a sustainable increase in labour supply. That's the hope and the dream, Mohammed. Is that the reality?
So Jason is right. I mean, if we didn't have the financial markets and if we didn't have a data-dependent Fed, then Jason would be absolutely right. The concern is the spillback from the financial markets and policy onto the economy. This on its own is really good news and will be welcomed by the White House. It will not be welcomed by the Fed.
It's not welcomed by the market right now. Equity futures down by 0.9% on the S&P. The jobs data looking really strong. I think we've all forgotten about that ADP report a little bit earlier this week. Yields up at the front end, up at the long end. On a 30-year, earlier this week, briefly through 5%, back through it right now. The 30-year, 5.02%, yields higher by 13 basis points and change. Mike McKee breaking down this jobs report. Mike McKee, I think you and I both just said wow when that one dropped.
Absolutely. I think the word that you'd use over in London is gobsmacked by this number. It really was a shocker. Nobody had anything close to this in the Bloomberg Economic Survey, and nor did the people on Wall Street trading desks. 336,000 jobs created, and then add in 119,000 revisions higher to July and August. The unemployment rate stays the same at 3.8%. Nothing really remarkable there. More people got jobs than lost jobs, but the labor market only grew by 90,000 during the month, unlike 700,000 the month before. The jobs numbers, the best part of it here is the average hourly earnings, just 0.2%, up 4.2% on the year. And the interesting thing about that is that this was a longer period of time, which is why some analysts thought we would get a high compensation number because more people would have gotten jobs during that period at higher rates. We didn't see that. Service industries, 234,000 jobs. And the interesting thing there, wages up only 1.7%. Leisure and hospitality continues its run, 96,000. Public education, this could be a seasonal adjustment problem with August numbers, up 40,000. And I threw trucking in there because we lost 37,000 jobs last month because of the Yellow company going out of business. 9,000 of them absorbed back. So a turnaround there that helps boost the numbers overall. Here's the good news for the Fed. The payrolls numbers go up so dramatically, and yet we see a decline in average hourly earnings on a year-over-year basis. To my mind, guys, this makes next Thursday's CPI report even more important because I'm not sure the Fed will look at this badly if the CPI continues to decline because the Fed doesn't necessarily want to see employment go bad. They just want inflation to come down.
So, Mike, is it possible to bring inflation down with such a hot labor market?
It's possible, depending on whether we see people spend more than they normally do. Spending's come down to about the point we were at pre-pandemic. The savings is gone. People are spending out of their salaries. So it is possible you can get back into alignment. And we've seen supply come into better balance. Doesn't look like there's any kind of wage price spiral, though. So, yeah, it's possible. That's what the Fed's not going to know.
Keep digging, Mike. Keep digging. We're all trying to work through this one. Mike McKee there breaking down the jobs report. Let's keep digging into this bond market as well. Treasury curve steepening, selling off at the long end. So yields are higher on a 10-year, on a 30-year, relative to the price move today on a 2-year. The 2-year's up by 8 basis points. The 30-year is up by more than 12. So the curve is steeper. 2's out to 10s by about 5. 2's out to 30 by about 5 basis points also. Mohammed, let's talk about the character of that steepness. We thought if we were going to get a steepening of this yield curve, it would be driven by the front end. The jargon, of course, is the bull steepener. You get a rally at the front end, yields drop because you're pricing in a rate cutting cycle from the Fed, who has to confront a slowdown in the economy. We're not seeing that. In your experience, Mohammed, how rare is it to see a prolonged sell-off at the long end of the curve, to see the steepness come from a so-called bear steepener?
You had Priya Mishra on earlier today, and she summed it up very well. This is very unusual. But there's a reason why this is so unusual. And that's because the characterization of the economy has changed in my mind. What we're seeing here, John, is just a massive reaction to not rates going higher. That was last year. That was the understanding last year. Rates are going higher, but if you remember, there was a hope that was priced in that the Fed would be cutting pretty soon. This year is about high rates staying there for longer. And that is a fundamental change of how you think about the yield curve, and that's what we're seeing playing out in the markets.
One phrase I've heard, Mohammed, a few times this week is buy a strike. Let's put some meat on those bones. Is this the investor basically saying, I'm not going out along the curve so long as it is inverted to take on a 10-year maturity for less yield when I'm seeing an expansion in economic data like that?
Yeah, and I also think, John, it's simply, I'm not going to catch a falling knife. That's what it is. I am going to wait on the sideline, see how things settle down. These moves are historic. They're absolutely historic. We're going to look back on this as, did we really move by that much every single day? And then the second thing to remember is that we don't know what the retail sector is going to do. There are very big losses right now in bond funds that are going to have to be somehow gotten used to. And then the last thing, John, I would say is, you know, a lot of people are saying the markets have functioned well. Yes, they have functioned well, but the extent of the moves suggests that there is something else going on. And people are asking the question right now, where is the pain? And today, the pain is going to be increased. So there's going to be a lot of people interested in seeing how the technicals evolve from here.
You and I have got a lot to talk about through the next hour. I'm pleased to say Mohammed's going to be sticking with us to break down some of the stuff we need to unpack, particularly at the end there. The prospect of things breaking, maybe even for selling, with all that unrealized losses sitting on some books somewhere out there in the Treasury market. Equities lower by about 0.8% on the S&P, with some movers going into the open. Here's Abby.
John, let's keep it macro and on this hot jobs report and yield steepening in the way that you all were talking about and the re-steepening of the yield curve. Let's take a look at technology, because of course as yields shoot higher, this makes valuation look less attractive. Microsoft down 1%, Tesla down 2.7%. Also weighing on Tesla perhaps are some of the Model 3 and Y price cuts here in the U.S. And then the banks not really getting a bid from yields going higher, or the re-steepening in the yield curve. You can see JP Morgan Chase, it's down 0.6% right now, John. The S&P 500 E-mini futures heading to a 5th down week in a row, the longest losing streak since May of 2022. So this idea of longer or higher for longer, it is certainly weighing on stocks.
Abby, there are some big moves out there, that's for sure. Abby's going to break them down for you in about 20 minutes' time around the opening bell. Coming up, much more on a monster upside surprise.
The incredible strength of the labor market continuing to be there. But the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that in a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks.
Perfect Goldilocks? We'll question that next. The conversation continues with Mohammed Al-Erin, Victoria Fernandez, and PGIM's Michael Collins.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The president went to Michigan very recently, just last week, a week ago actually, to show his support and to stand in solidarity with union workers. And that is, he did that because he believes that unions have the collective bargaining rights to ask for fair pay and fair benefits. He believes, as it relates to UAW, record profits should lead to a record contract. The president is always going to be proud of being the most pro-union president ever.
The labour market in America at the epicenter of conversations this morning. The White House pushing the president's pro-union agenda as the UAW strike continues. And if a deal isn't reached soon, the impact could be wide-ranging. A full strike involving all 150,000 UAW members could impact 760,000 jobs and show up in October's payroll report. September payrolls coming in much hotter than expected. Kelly Lyons joins us now for more. Hey, Kaylee.
Hey, John, way hotter than expected. And that 336,000 print on payrolls for the month of September is certainly something that here in Washington, the Biden administration is going to be touting as a sign that Bidenomics is working. We'll hear more from President Biden later on this morning at 11:30 a.m. Eastern time. The difficulty, though, for President Biden is, on the one hand, yes, he wants and frankly needs a strong economy and labor market as he campaigns for re-election in 2024. But he also wants to be the most pro-union president in history, as he is often dubbed himself. And that is where potentially you could see things running into conflict. Our team here at Bloomberg Economics says a prolonged UAW strike, because of its secondary effects, could mean that every striking worker leads to the loss of 5 jobs in total. And when you add it all up, that is where the number of north of 700,000 layoffs comes from in the worst case scenario. And our team says if this strike lasts for 2 months, you could see 0.4 of a percentage point knocked off of fourth quarter GDP. We'll, of course, get more information as to whether or not the strike is expanding later today, 2 p.m. Eastern time, another Facebook Live from Sean Fain. And we know leading up to today's announcement, we have seen GM making a 6th contract offer to the UAW. Reportedly, it is a sign of progress, but not necessarily enough to stop the strike because it still comes up short of the latest offers from Stellantis and Ford. Ford, of course, made its 7th offer to the union this week, including pay raises of more than 20%, some sweetened contributions to the 401k as well. We'll see if any of it is enough to spare any of the big three an escalation later today. John.
The longer this labour market stays hot, the more leverage they get, that's for sure. Kaylee, thank you for the update. Joining us now to weigh in, PGIM's Mike Collins, Crossmark's Victoria Fernandez, still with us, Mohammed Al-Erin. Victoria, first to you. Your reaction, please, to a blowout headline number.
Yeah, Jonathan, it was a much higher number than we were expecting. We did think that we were going to continue to see growth in the job market. We know that we're not at the point where we're going to get a negative number. What we were really focusing on was average hourly earnings. You're just talking about all of the wage strikes, how that's going to feed into any kind of wage spiral that we see and what that means for the CPI report coming next week. We saw that go to around a 4.2% year over year. You combine that with a participation rate that didn't seem to go much higher, then I think that's where the elements are going to lie on how strong exactly is this labor market. You know, we had the JOLTS report earlier this week, and the one thing we have to look at is the quits rate is actually slowing. And I think some of that is because the wage difference that a lot of people were getting when they were changing jobs was up around 16, 17% higher. That's come down to single digits. So I think you're starting to see people level off a little bit in the rate of change for their jobs. We still obviously have a very strong labor market out there, and I think that's going to be difficult for the Federal Reserve. I know higher rates, Mary Daly was saying that that's like a rate hike, that takes the place of a rate hike. But when you have numbers this strong, and if we get a CPI number that does not show the level of disinflation that people are looking for, I think the Fed is back in the hot seat of needing to hike another 25 basis points.
Mike Collins, Francis Donald of Manulife this morning saying this: a soft landing negates the probability of a soft landing. A soft landing is not bullish for any asset class. Mike, what are your thoughts this morning?
Yeah, Jonathan, we've certainly been in, I don't know if I'd call it the soft landing camp, but, you know, a resilient economy camp, right? And you've seen it in so many ways, and this is certainly reflecting that. And we've also been in this, you know, higher for longer rate view, but I have to admit, I really didn't expect the extent of the job growth to continue. And maybe this is one number, maybe it's a flash in the pan, but the real surprise to me in the markets, and I think where maybe the markets are mispricing, is the extrapolation of the Fed's higher for longer narrative that has happened has reached pretty extreme levels, right? I mean, the markets are now pricing in. So bond geeks look at five-year interest rates, meaning what's priced into the market, what the market's crystal ball is telling us for the next 10 years. And right now, the markets are pricing in a Fed funds rate that only goes down to about 4.4% and stays there forever. And a 5-year treasury that only goes down to 4.80, meaning it barely moves from here and stays there for 10 years, right? And it's really hard for someone who's been in the bond market this long to really grasp the idea of a funds rate that's in the fours, the mid fours, for 10 years, right? At some point in the next 10 years, it's probably going to be lower than that. So that's really what's happened in the bond market, and it's really shocking.
So, Mike, I'm trying to understand where you're going with this. There's two possibilities. One is that the market simply is wrong, or two is that it's hard to reconcile the market's interpretation of higher for longer with your hope for soft landing. So which is it?
Yeah, the markets, these long-term forwards, Mohammed, as you know, they are wrong all the time, right? They overshoot, and investor behavior drives that, right? And what you've been talking about, Jonathan, this morning is the investor psychology out there, what they're thinking, and they're terrified of stepping in front of this rate sell-off. So they're all piling into cash. I've been speaking with a lot of investors over the last few weeks, and they are really hunkering down in the front end of the yield curve, holding on to cash. They've kind of given up on owning these longer term bonds, and people obviously are selling this morning. People are shorting treasuries through futures. So you do get these big kind of extreme moves, Mohammed, typically, in the deep parts of the recession and at the peaks in growth and at the peaks in Fed funds rate hike expectations. And it feels like we're kind of, bouncing around one of those peak periods and one of those extreme periods in terms of the permanence of what's priced into the market.
So, Victoria, if this migration to cash from both public equity markets and public fixed income markets continues, how does it impact your outlook?
Well, obviously, we want to see people be invested in the market fully. And even though we have had a negative outlook all year, I mean, we have been in that camp that said the soft landing probably wasn't going to be our outcome. We've actually been investing on some of the parts of the longer end of the curve for our clients. We don't want to just sit completely in cash or completely in a 3-month or a 6-month T-bill and have reinvestment risk coming. So the fear would be that if everyone is sitting in cash and they're waiting to try to time the market, they're either going to miss that, which is probably what's going to happen, or you're going to have a huge influx at one time and cause a lot of volatility. We would suggest, and what we're doing with our clients on the fixed income side, is you really need to barbell that. You need to have some exposure to cash or cash equivalents or short-term treasuries. But look, we're at a 490 on the 10-year treasury. I'm not sure how much higher many people anticipate it will go. Technicals tell you maybe around a 510 or a 520. If you're buying individual bonds, you're buying at a discount right now, collecting your coupon, and you can hold that bond till maturity and receive par for it. So I think there's something to locking in these higher rates on the longer end while still having some flexibility and some liquidity on the short end, especially as we see liquidity coming out of the market. In the reverse repo market, we're seeing it with foreign treasury buyers going away. I think there's some liquidity components that we need to address as well.
Victoria, we'll talk about that. Mike Collins, Victoria Mohammed sticking with us. Your 10-year this morning, a cycle high briefly, 488, right now 482. Coming up the morning calls and later, Acting Labour Secretary Julie Su with the latest on the jobs report.
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Four minutes from the opening bell, equities trying to recover here. Let's get you some morning calls. Your first one from Oppenheimer, downgrading a rally to market perform, expecting limited upside as pandemic-related tailwinds continue fading. Bernstein initiating coverage on Netflix with a market perform rating, seeing a mixed outlook due to mounting competition and slowing growth. And finally, Jefferies upgrading Elf Beauty to buy, seeing an attractive buying opportunity after recent declines. Coming up, the opening bell with more from Mohammed Al-Erin and Victoria Fernandez alongside Michael Collins, and later, Acting Labour Secretary Julie Su weighing in on the latest payrolls report. Your opening bell just around the corner.
The younger generations are more, of course, pay more attention to sustainability, And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Four seconds away from the opening bell this morning. Good morning to you all. We pull back on the S&P. Off-session lows just on the Nasdaq. We're down by 0.8%. On the S&P 500, down by 0.6. 5 is not the magic number. We're heading towards a fifth week of losses on the S&P, unless that changes. There's your opening bell. Switch to the board and get to the bond market. Heading towards a fifth week of yields climbing on a 10-year maturity. Your 10-year this morning higher by 12 basis points to 484. Yields up, dollar stronger, euro lower, 105.12. The euro poised for a 12th consecutive week of euro weakness against dollar strength. The dollar absolutely dominant in G10. That currency pair pulls back by a third of 1%. And crude, look out below all week, heading towards the biggest weekly loss potentially going all the way back to March. Crude right now positive by 0.6%, 82.83. About 30 seconds into the session, this looks better than it did about an hour ago. On the S&P, we're down about a half of 1%. On the Nasdaq, down by about 0.7. One stock to watch at the open is Exxon, the energy giant in talks to acquire Pioneer Natural Resources, nearing its largest takeover since 1999. Citi saying the following: the logic of consolidation in the highly fragmented Permian shale remains compelling, with significant gains to be achieved. Abby has more. Hey, Abby.
Hey, John. And yes, this is a big one. So sources are saying that ExxonMobil is very close in advanced talks to acquire Pioneer Natural Resources. It could value Pioneer at $60 billion. Yesterday, Pioneer had been worth $50 billion. They, of course, are one of the premier producers from the Permian Basin, which is basically runs from parts of Texas and New Mexico. It's one of the most lucrative parts of the oil patch in the U.S. because it's much more easy to extract the oil. So what this would give Exxon essentially is, rather than buying a company where they would potentially have to develop unproven acreage, almost like a faucet where they can turn it on and off. So when oil is lower and volatile, and it's been weighing a little bit. ExxonMobil into today had been down about 1%, and Pioneer into today down about 5% on the oil volatility, plus concerns that there could be a global slowdown and that would weigh on oil. But if there was a resurgence, they basically just have to bring out this oil. It's not quite as simple as that, but that's one way to look at it. Now, sources are saying that this deal could close in coming days, but it might not be super easy, John, because there could be some solid political and regulatory issues, scrutiny, given the fact that earlier this year, in February, the White House did accuse Exxon of achieving what are called bumper profits at the expense of consumers. Stay tuned, but right now we do have Pioneer up about 8%, Exxon down 3%, suggesting that many do think that the deal could actually go through.
Stay tuned. Abby, thanks for that. Let's turn to the autos. GM presenting its 6th contract offer to the UAW, writing in an email that they're ready and willing to negotiate in good faith 24/7 to reach an agreement. This coming as Union President Sean Fain prepares to deliver an update on social media at 2 this afternoon. Simone Foxman on top of this story. Hey, Simone.
Hey, John. Yeah, all eyes are on that announcement, which will be Facebook Live, YouTube, etc. in this day 22 of the United Auto Workers strike. We could hear plans to expand the strike today. Right now, 25,000 United Auto Workers are striking of the 145,000 total population. And so far, the strikes haven't impacted the plants that produce the full-size pickup trucks, the large SUVs that are the most profitable for these companies. So we're very much focused on where we see those potential strikes expand, because they could have more of a hit than we've currently seen on their bottom line. And we'll also be looking for whether or not the union is going to reward progress on some of the talks, including perhaps with GM, where it does seem both sides have made some progress a little bit on retirement benefits, even though GM very much focusing on strengthening 401ks. However, despite that announcement, from GM that there was this offer submitted. We saw shares close at their lowest since September 2020. Ford has also been under pressure, really lowest since August. Stellantis is holding up better a little bit because of its global operations, and shares of all those companies are down, or Stellantis unchanged today.
Simone, thank you. More on this story with the Acting Labour Secretary, Julie Su. We'll cover this in about 10 minutes' time. Let's check out shares of Tesla right now. Tesla cutting prices on its top-selling models in the US again after Q3 deliveries fell short of estimates. CEO Elon Musk taking to X to challenge his critics, writing this: "Sometimes they question if I should even run Tesla. My response is simply, watch other CEO. Would you prefer?" Isabel Lee has more. Hey, Isabel.
Hey, John, lots of markdowns across the board. The company slashing the starting price of its base Model 3 by $1,250. It's slashing the long-range version of the sedan by the same amount. And the Tesla also shaved some $2,000 off the price of the performance version of the Model 3, as well as the performance versions of the Model Y sports utility vehicle. So what do these discounts mean? Two things. It will dampen the company's profit margins, but it will help stoke demand. And we have the CEO, Elon Musk, downplaying the trend so far. He said that, the company could sacrifice earnings up front, but it could make it up by software upgrades. Tesla shares are now dropping by some 2.5%. The stock has more than doubled this year, John. It's up by 1. This year, John, it's up by 111%. Tesla has delivered some 435 vehicles in the last 3 months, but it's still short some 20,000 of what analysts were expecting, John.
What a move on that name this year. Isabel, thank you. 254 in early trading. Let's finish on consumers. Levi's wholesale concerns persist after reporting third-quarter results. The CFO saying this: "Given the ongoing uncertainty in the macro environment, we're taking a cautious approach to our outlook for the fourth quarter." Katie, that stock down 3%.
Yeah, it is a down day for denim. Quarterly revenue came in light, and that led the company to take a, quote, more cautious approach to its projections. Levi now sees EPS at the lower end of its previously stated range, while scaling back its revenue outlook as well. Now, if you take a look at the last few quarters, Levi actually either met or beat its estimates, which makes, of course, this latest round of earnings even bleaker. And of course, they're the first major U.S. apparel retailer to report, and their results are closely watched for that reason. Levi's CEO told Bloomberg News in an interview that, quote, "Middle-income consumers and below are definitely being impacted, especially here in Europe, but that's also true in parts of Europe as well." Now, the sell side not too impressed. While the direct-to-consumer business was a bright spot, it was the wholesale business that remains a concern in some of the reports coming out this morning. And you can see that in the shares. Levi currently down about 2.7%.
Katie, thank you for the update. Allow me to give you the update for the broader market. If you're just joining us, where have you been? You missed it all in the last hour. The jobs report, a blowout number, 336,000. The estimate, 170K. The previous number, 187. The move you might expect. About 16 or 17 minutes in, or rather 6 or 7 minutes in, equities are down by about 0.5% on the S&P. The Nasdaq's down about 0.5%. Major moves in this bond market. Yields up another 12 basis points to about 484 on a 10-year, on a 2-year, back to 5.1%. On a 30-year, we're back at 5%. We're back now with PGIM's Mike Collins, Crossmark's Victoria Fernandez, Mohammed Al-Arian. Mohammed, I want to come straight to you and ask you about the financials, the banks. Typically, we talk about good data, higher yields, good for financials. That's not happening. Why not?
I think the markets are concerned about two things. One is the impact of higher NIMs, potentially. Higher net interest margins are being offset by deposit outflows out of banks into money market funds. The second issue, which is of more concern to the market, is that there's a worry that if interest rate risk continues to be in play like this, it will translate into credit risk and liquidity risk. And I think that is what's being captured by yet more pressure on the financials.
Victoria, is that something you're worried about?
Yeah, I mean, I mentioned a few minutes ago that we were concerned about the liquidity issues that we're seeing in the market, and I think that's part of what you are seeing in the financials, along with the fact that you're seeing like Citi say that charges on credit cards was actually down over the last few weeks. So the consumer is getting hit a little bit harder. That has to be concerns growing then around lending, around delinquencies on credit cards. All of that feeds in to what these financials are doing. And when you tighten those financial conditions and when you squeeze the liquidity that's in the market, financials are not going to do well, even with the re-steepening of the curve. I do think, however, we'll see financials start to come back because their balance sheets are strong. So even with all the macro data that's going on, the balance sheets themselves should be able to hold through the volatility. So I think you want some exposure to them for longer term holdings in your portfolio.
Mike Collins, I want to talk about these unrealized losses in this Treasury market. The price destruction in treasuries, particularly at the long end, since we peaked back in spring 2020 has been absolutely phenomenal. The team here at Bloomberg broke down the numbers earlier in the week, and at the time that story was published, the numbers looked like this. Bonds maturing in 10 years or more, they've dropped 46% since peaking in March 2020. 30-year bonds, even worse, tumbling 53%. These are monster moves, Mike. They're getting even worse this morning. Mike Collins, who owns that? Where's that pain right now? Where's it sitting?
Yeah, Jonathan, that's exactly where I wanted to go. And that's kind of the third leg of Mohammed's stool that could hit not only financials, but broadly the whole economy, right? And who owns those bonds? Fortunately, you know, the Treasury or the Fed owns about 8 trillion of them, right? So that actually does cushion the blow to the private sector. But insurance companies own them, pension plans own them, individuals own them. And it's not just bonds being marked down, Jonathan. It's all asset prices. I just came from a real estate conference, and people are really worried about the potential for a lot of forced selling. A lot of people bought real estate at high prices over the last couple of years, and those marks are moving down, and they still have a long way to go down from where they are today. And the financing cost, if you didn't lock in your rate, is going in the opposite direction. So a lot of these are now underwater, right? So it's really across the whole economy. You see it in stock prices every day. But it's really the slow-moving prices. It's the private debt. It's the commercial real estate. That's another shoe that hasn't dropped yet.
So, Mike, I want to push you a little bit more on this, if I may, because it's not just domestic, it's global. People are also worried about the spillback from the Japanese reaction. So is this a slow-moving process that the market can accommodate and the economy can accommodate? Or is this something we should be worrying about tipping points?
You know, I think it is a slow-moving process. Our base case, Mohammed, is that there isn't as much leverage in the system generally. Like a lot of this real estate hasn't been overbuilt. It hasn't been levered. Certainly the housing market is not levered at all. The banking system, as Victoria pointed out, is not a levered system anymore, right? So that's really good. But as the realization of these lower asset prices, and you do get liquidity events and flows where people have to, realize those losses at some point. And so maybe it takes quarters or even years to get realized, not days and weeks, but that is something that does nag at us over the intermediate term and make us certainly more cautious on the global credit markets in general.
Mike, we've heard a lot of Wall Street phrases, cliches through the week, catching falling knives, buyer strikes, all of that bad stuff. Mike, your colleague, Dalip Singh, talked about the loss of predictable demand in the Treasury market, China, the Federal Reserve. Mike, that's not coming back potentially. How does that change things? That change of character in the sources of demand, what does that mean for this Treasury market, this Treasury curve?
Yeah, I mean, part of that, believe it or not, Jonathan, again, this is kind of wonky stuff. Some of that is priced in. If you look at long-term Treasury yields versus long-term expectations of the funds rate or other derivatives on that interest rate, it's about a 70 basis point yield premium that the Treasury is actually paying every time they go to the auction block to issue Treasury. So there is a supply premium already built in. You could call it a credit premium in some cases on the Treasury market, built in already, and that's one of the reasons that yields are at these higher levels. And whether that persists or not is anybody's guess, but it's a little encouraging that a lot of that is priced in.
Mike Collins, thank you. Mike Collins alongside Victoria Fernandez, together with Mohammed Al-Erin. I'm pleased to say Mohammed's going to stick with us. Stocks pulling back by about 0.6% on the S&P 500. Up next, the September payrolls report coming in hot.
This is a much stronger labor market. Clearly, that's what we see in the report today across the board.
Acting Labour Secretary Julie Su up next.
This week saw the beginning of the criminal trial of the United States versus Sam Bankman-Fried. We are recording on Thursday afternoon, and you and I were together in the courtroom, or at least in the overflow room, I guess. So what are your biggest takeaways from the trial so far?
Wow. Well, that was a lot of information. I mean, that's one of the big things that comes to mind. So one of the takeaways, and I'll say nothing is legal advice, investment advice, nothing like that, just personal views only, as usual. But there was so much to hear and so much detail to understand. Now, one of my takeaways was the judge, in his own respectful way, was saying, okay, this is too much repetition. Let's not keep going over the same thing. He said that on several occasions. But as I was sitting there personally, hearing about all of these sorts of things from, depositing your stable coins, your fiat, and the methods for that, or your crypto, things like that, all the way to, okay, VC investments and due diligence and financial statements and coding and developers and traders and all the sorts of things. I kept thinking to myself, we've been in this space a long time. For people who may not have any technical background or legal background or have not been in the space as you have, right, as like leading journalists and things like that, this is a lot to take in. And so that was one of my big takeaways, was that it was information. What is the saying? Like drinking from a fire hose. And I was trying to, we talked about this earlier. My hand was so sore from taking furious notes, and I just kept wondering, how much of this is sinking in and what will the jury remember?
Yeah. And so I happened to be there during the jury deselection, as one of my guests called it recently, because even though it's typically called jury selection, he's right. It's actually a process of deselecting people. And what I ended up noting was the different professional backgrounds of the jury are physician's assistant, social worker, Metro North train conductor, librarian, United States Postal Service vehicle maintenance worker, special ed teacher, a nurse. There was a Ukrainian woman who worked in advertising. And then there was a retired investment banker. He's actually born in Hong Kong, and he's retired now. But, it was also, by the way, I think 3/4 women and 1/4 men. So like, given, this kind of, background basically of the jury, what are your thoughts on, how this is going over with them, or how this could affect the trial?
Well, one way I think it has affected the trial is we went over in painstaking detail, step by step, watching videos of, again, how to, deposit money, how to withdraw money, all these things step
Onto
by step.
FTX.
Yes, as though you're actually doing it. We listened to the video. And so I think that was done to get to level set, really, to bring everyone up so that when they start talking about, okay, well, what was the balance in the account, right? We had the tutorial of how to pretty much create our account, right? And what to do. And things like, okay, you're going to send wire instructions to this named beneficiary. You got to get it right. And then lo and behold, that named beneficiary keeps coming up again and again because it's actually an account owned by Alameda, right? So I think that's part of it, just the building blocks, the constant building blocks. But I think for the prosecution, what they're trying to show is no matter that it's a highly technical area, the allegations are this is simple fraud, right? This is untruths. This is misstatements. And this is, inducing people to trust or to invest or do other things on false, pretenses. And I think, so that is the message on the one hand. From the other side, the defense, and certainly we saw this with the opening statements, but also throughout in some of the cross-examinations today, which I'm sure we'll talk about, but trying to say, like, look, this case is based on hindsight. Just because FTX went bankrupt, just because all these things happened, that doesn't mean that there was fraud involved. That doesn't mean that there was conspiracy, because guess what? The whole digital asset space was going through crypto winter, and we had all of these other events. So, and maybe we'll go into some of the statements about, bulletproof and things like that popped up. But there were some notable quotes, and some of them were pretty surprising today.
Yeah. So just so I know you weren't there the day that they gave the opening statements, which was Wednesday. But I know you did read, yeah, a little transcript that I was able to send you. So just from that, like, what was your take on the opening statements of the prosecution and the defense?
I think, I mean, as I kind of said, like they're trying to simplify it, right? They're trying to say, like, look, SBF was larger than life. He was living in a $30+ million penthouse, right?
You're talking about the prosecution.
Yes, exactly. The prosecution was trying to show this. This is a person. This being broadcast into your living room. The person who positioned himself as being, the face of crypto, and you can trust him, and the adult in the room. And yet, in the prosecution's view, it was all a lie. So, trying to give that kind of simple message without going into so much detail. For the defense, as I mentioned, a lot of it was saying this is a backwards looking thing, but also saying, like, look at who is testifying. Look at who these alleged co-conspirators are. They're people who got deals, right? And you need to think, jury, about why they might be testifying in a certain way. And I think another thing was, and this has been something that the defense has been trying to show, is look, there was no intent. Like there was no fraud, and there was no fraud also because there was no intent to defraud, right? Like the things that are being alleged by the prosecution, the defendant thought were legal. For example, loans from FTX to Alameda, things like that, where there was reliance upon other people who were more knowledgeable in that area. So I think that's what I really took away from both of those, the opening statements. They were both impassioned, of course.
Yeah, and just one thing that I wanted to clarify, because I saw some of the other media accounts didn't have this nuance, but about whether or not there was ever a plea offer to SBF. I saw some of the other media were saying that the government never offered a plea deal. However, there was a nuance there, so it's not quite accurate. Basically, at the beginning, the government said, we would like to put on the record kind of like what happened with a potential plea deal. And they said that basically shortly after SBF was charged, the prosecution did raise the possibility of plea discussions with the defense, and the defense refused. And so therefore no discussions ensued, which is why there was never a plea offer that was made. So it really sounds like Sam was the one who decided, no, I'm not going to do a plea deal. I'm pleading not guilty. So it really is more his decision than it was the government's, at least from their recounting of it. That is what I took away. Let's now just jump to the first witness, which was a customer of FTX. He said that he had lost, I think, because he was a British. Well, he's actually Parisian, but he lives in London. And so all of his, I think, or not all literally, but his account balance was likely in British pounds, and converted, I think it was like between $140,000 and $150,000 that he lost. And he cited things like the fact that Sam had tweeted in the days leading up to the collapse of FTX that, FTX assets were safe, customer assets were safe. And so he didn't try to even attempt to pull his money out until November 8th, which was, of course, the day that its insolvency became apparent. So I wondered what your thought was about the selection of this person as the first witness.
So I thought it was an interesting choice. Part of the reason I think it's an interesting choice is that today, and I'm sure we'll go into this as well, we talked about, or I wasn't doing any talking. None of us were doing any talking, we're listening, right? But some of the testimony centered on what kinds of efforts and methods were implemented by FTX to exclude US customers, right? So I thought it was interesting that they have someone whom the defense established in the cross-examination had never met SBF, had never emailed him, had no contact with him, and was not a U.S. person, right? Or a U.S. resident. So I think it is an interesting choice because he in fact appears to have lost money. He could speak saying he relied upon Giselle and others, right? And feeling confident that because these investment firms VCs and others had invested hundreds of millions of dollars, that they must have done their due diligence. So I think it was interesting to hear for the jury to think about what someone might have had in mind, why they might have trusted FTX. At the same time, I do think, and I don't know how much how much this is being communicated to the jury or how much the jury is taking this in. But if the people who are harmed that are being shown are outside the US, or they are multinational companies that have invested from vehicles outside of the US, query whether that will matter to the jury, right? Maybe it won't, because these are people who are harmed. Certainly, alleged wrongdoing is there, but it's just really interesting to me in the context of today's KYC, AML, geo-blocking sort of discussion about methods to keep US residents and those located in the US outside of the customer base for FTX. What I also thought was interesting is that my recollection is that the witness had described, and I wasn't there for the testimony, but just my recollection based on what I read, was that the witness had said something like it was an unregulated industry. And on cross, it was very interesting because the defense had said, well, you were able to invest in this because it was unregulated, right? Now, holding aside whether it's regulated or unregulated from a legal perspective, but what essentially the defense had said was, look, if it had been regulated, if it had been, then you would have had to have reported those investments to your firm.
Yeah, and just to clarify for listeners, it was because he was a commodities, was it trader?
I believe so, yeah.
Yeah, and he traded cocoa. And so I guess if he was to invest in anything regulated, he would need to report it to his employer. But because crypto fell outside of, whatever the existing rules were, then he didn't have to report that.
And there was another exchange where the defense, I believe, said something like, you knew that crypto was risky, that investments in crypto were risky. And then were you relying upon, these folks when you were investing in crypto? And so the witness, Mr. Juilliard, I believe, he basically said, well, no, I was relying in order to use FTX, right? So that kind of a distinction. But yeah, I think it's interesting that, and I'm sure litigators out there, I'm not a litigator, full disclosure, but I'm sure folks may have a reason why he was the best opening witness. But it's interesting to me that the prosecution didn't call a US resident or US person who was harmed. So I wonder why, right?
Yeah. All right. So in a moment, we're going to talk about the more heavy-hitting witnesses that testified later on Wednesday and then through Thursday. But first, a quick word from the sponsors who make this show possible. Looking to venture into the world of stablecoins? Explore the open source Stablecoin Studio Toolkit on Hedera. Whether you're building the next big thing in back to my conversation with Josh. So the second witness was a longtime friend of SBF's, Adam Yedidia, and they met each other at MIT, and Adam later became a software engineer at FTX. He also, I think, spent a short time as an intern at Alameda. And he talked about the fiat@ftx.com account, which it was discovered had a bug. Tell us what happened here and what your takeaways were about this incident and why they brought it up.
Sure. So it was This came about after we had the building block videos saying, like, here's your balance, here's how you get your money into your account, right? And so, lo and behold, as we're going through all this, we don't quite realize that this one account is owned by, that is the beneficiary account, is owned by Alameda. Why does this matter? Well, we find out later. But at the time, when we're just watching the videos, you know, we say, okay, customers putting their money in there, it's going to update their balance, great. And it turns out that actually that was what was being done, generally speaking, in terms of updating the balance. And it was being done manually by a settlement team. But apparently, due, at least as was testified, due to the tremendous growth of FTX and the customer base and, you know, the deposits, the settlement team was getting overwhelmed. So SBF at one point requested of Mr. Yedidia that he create code that would allow the automation of these deposits. Now, he created that, and I should step back for a moment. So the account held by Alameda was held at Silvergate Bank, at Silvergate. And so he created API, right, to have the Silvergate and FTX computer systems talk to each other, right? So it could be an automated update. What he didn't realize when he was creating this code, which evidently everyone was extremely busy when working on these things, was that there was a bug. And let me just stop. I think I should stop here to say why initially this account was in the name of Alameda. It was in the name of Alameda Research because FTX was having trouble getting a bank account. And we later learned in later testimony that actually Alameda Research allegedly was named Alameda Research, we learned in Gary Wong's testimony, to have banks not realize that there was involvement with crypto and trading. I think there was, we can go into that in a little bit. But basically, so they were using this bank account, and the idea was that when the money came in, it was the customer money was going into this account held at Alameda, and there was an account in the internal, you know, workings database of FTX that was called fiat at FTX. And so what would happen is when the balance went into the Alameda account, for every dollar that balance that showed up on the customer's, so a customer would send in money, it would appear in the balance on the screen for the customer's account. Many, I'm sure, have used this for FTX in the past, so probably no, but we just saw it on the screen today. So it would go up, but then this account at fiat at FTX would show a negative number, right? Because it would be a liability of Alameda to the FTX customers. And so what this bug did, we still don't know exactly how it went in there, but it was some kind of, we presume, error. It actually didn't show that when money was withdrawn, that number should have gone up. It should have become less negative because the liabilities from Alameda to the FTX customers should have lessened. So it would be less negative of a number. But the bug actually didn't update. So when these automated changes occurred, that never updated. And what we learned actually was that I believe, and I'm just trying to look quickly to see if I can pull it out because I have way too many notes for this. When they first discovered the bug, there was a 500 million. So 6 months after the automated situation was created, it's not a situation, but once it was created, it was at 500 million. It overstated the liability. So it actually looked like Alameda owed more to FTX US customer, or not FTX US, just FTX customers, I'll decide FTX US, than it did. So it actually looked worse than it was. But by the time the witness actually fixed this bug later, 6 months later, the bug had overstated the liabilities by $8 billion. So it looked at the time like Alameda owed $16 billion to FTX customers. Now, interestingly, we learned that the bug was fixed. A report was created and allegedly was sent via disappearing signal message to the defendant. And the report did say there was an $8 billion overstatement, but it didn't say, hey, guess what? Alameda still owes, after the bug's fixed, $8 billion to customers.
Are you saying that Adam didn't relay that to anybody? Because I think he did.
Oh, yes,
Yeah,
he did.
he did.
Yes,
He
it
said
just wasn't in the
there's an
report.
$8 billion hole. Alameda owes $8 billion to FTX.
Exactly.
And then there was a conversation.
Exactly. And actually, a lot of time, yes, he absolutely did say that. It was just brought out by the defense that wasn't in the report,
right. Okay.
that remainder. But yes, so the prosecution and the defenses came up in both instances was focused. We even saw a picture of this paddle tennis court, you know, in where they had this discussion where basically, I guess after discovering that there was this $8 billion owed, Adam Yedidia, he was concerned because, as he said, it was like an extremely, large amount.
Yeah.
He said basically, are we okay, right, about this $8 billion? To which it was reported that SBF said, well, we were
bulletproof last year.
We were bulletproof
but not
last year.
bulletproof
Not
this
sure
year.
that we're bulletproof this year. And it was later phrased when it was rephrased in other testimony, it was later phrased as we're not bulletproof anymore. And so Adam Yedidia asked SBF, how long until we're bulletproof again? And SPF reportedly said 6 months to 3 years, he thought. And so this, they made a lot of detail about this, and the demeanor of SPF, and that he seemed concerned, and that Adam, who had known him for many, many years, said it didn't seem like his normal demeanor. Now, later on, what's really interesting is that the defense revisited this and said, you know what? Do you really know? Do we really know what bulletproof meant? Could it have meant, like, look, we had the collapse of Voyager, we had Three Arrows Capital, we had all this stuff going on, crypto lenders were in distress. Could that have meant, like, could anyone have been bulletproof? I'm simplifying this because there were, like, many objections that were sustained and things like that. But
yeah, I think that was objected and sustained.
Yeah, exactly.
Yeah.
But there were a lot of things like that where they were trying to plant that seed. And then on redirect, this was brought up again, and the prosecution had Adam make clear that actually, no, this was right after I asked specifically about the $8 billion. And so there were a number of things like that, and a number of, like, really surprise statements. There's so much to talk about. Like, I don't even...
So let's skip to Gary Wong, because he's the co-founder and CTO former of FTX. And I was really surprised by one particular thing in the beginning, which was literally in the first, 1 or 2 minutes of his testimony, the prosecutor said, did you commit financial crime? And he basically just right out of the gate said, yes, wire fraud, securities fraud, and commodities fraud. And then I did get one quote, which was, he elaborated and he said, we gave special privileges to Alameda Research to allow it to withdraw unlimited funds from the platform and lied about it to the public. So, though that just really set the tone for his testimony. Talk a little bit about what your main takeaways were about Gary Wong's testimony.
So one was his demeanor. He seemed kind of happy. I mean, I don't know him, but it didn't seem like he was like, oh, like this is horrible that I'm up here. I mean, when he had to identify the defendant, he was standing up and looking, and I just think that was surprising to see. Just his demeanor was, in my view, quite calm, unless he was projecting something otherwise. I think some of the takeaways, like you said, the preferential treatment, he emphasized, it was written into the code. And when he talked about the different kinds of preferential treatment there were, he mentioned, for example, they had the ability to make unlimited transfers and withdrawals regardless of what was in the Alameda bank account, so they could have a negative balance. And they also said, he said, by the time of the FTX bankruptcy, Alameda had withdrawn $8 billion, right? There's that number again. And then with a line of credit, this was another thing in terms of the preferential treatment. So he was asked, what would a normal line of credit be for the market, a market maker? And he answered, it would be in the single or to double digits of millions, right, for a line of credit. And what was Alameda's line of credit? $65 billion. Okay. And then also, so Alameda didn't need to post collateral. Evidently, Alameda had the ability to trade slightly faster than other market makers. And yeah, there was just really interesting things. And of course, he said the advantages were not disclosed to the public.
Yeah.
And
Yeah, and you talked about they could even see into the order books, I think, a little bit to get ahead of people for trading.
yes.
Yeah, actually, one other thing. Talk about drama because Gary actually spoke rather quickly, I found.
Yes.
And so this point about the $65 billion line of credit versus for the other market makers, initially what I heard was that Alameda had a $65 billion credit and the other market makers had lines of credit that were in the single digit to double digit billions. That's what I thought he said. And
That's
so
what I thought
they
you said
had,
at first too.
yeah. And I remember thinking, wow, like that's crazy. Um, but then when it got clarified, I was like, oh, okay, that makes a lot more sense. Cause I was like, why would you just allow, I don't, anyway. So the point is, yeah, but then it became, I remember writing in my notes, like, wow, in all capital letters when it got clarified what that really meant. So one quick thing I wanted to do also, because I totally forgot to mention this about Adam Yedidia, but the final point, so basically there was the cross-examination and then the prosecutors got to go again. And, because I think the cross-examination was like, hey, you found out in June that Alameda owed $8 billion to FTX. Why didn't you leave then? And so then when the prosecution went back, he revealed that the reason that he finally resigned in November was that because he found out that Alameda had used FTX customer funds to pay back its lenders. And back in June, he had thought Alameda had the money to pay FTX customers. But upon realizing that they had to use the FTX customer money to pay their own lenders, that's when he realized they didn't have any money. And so that was why he didn't leave right away, because he thought he thought they had the ability to pay it back, but they just hadn't, they had borrowed it. And then he realized, oh, they don't have the money. So any last thoughts that you want to make? And we can throw in anything about Matt Huang here as well if you want.
Sure. So there were so many interesting points of the day. But one of the things I thought was really a strange choice was that on multiple occasions, the defense counsel for SBF was trying to get Adam to agree that FTX was like the New York Stock Exchange. And I realize this is not part of the case here because we're not questioning whether it's securities or like what these mechanisms are. But I just thought that was a really interesting choice given the backdrop of market structure and other types of conversations that are going on, to continue to draw this distinction or this comparison to the New York Stock Exchange. I think also the witnesses today struck me as, I'm not a juror, but they struck me as really credible. Even in one instance where Adam Yedidia apparently misspoke during the first day of his testimony when he said he had not received a subpoena, when he had the chance to correct that, he did. And he said, I'm really sorry, right? And it was credible. And frankly, the way, I don't know if it's because he's a developer or he just is a really naturally great witness, but he was really parsing the answers to the questions, but it didn't come across, at least to me, as though he was trying to be difficult. It literally seemed like that was his personality, and he was trying to, give the exact right answer. And I think that, he struck me as a credible witness. He did have a pretty shocking statement that was stricken from the record, so I don't even know if I should mention it, what it was, but it related to whether, why did he change his view about FTX? So I'll just hold aside what that statement was.
No. I think you and I could discuss it.
Okay.
But yeah, like the jury can't know it, but.
Oh, I guess that's true.
Right.
So when during redirect, because the defense had tried to say like, okay, so really after having a conversation with this other trader about a conversation that she wasn't even at about, the use of customer funds, that's when you decided to quit, right? And not when you found out there was $8 billion owed. And that's when it went into the part that you were talking about, Laura, where he said, well, I thought they were still available, right?
Yeah.
He was later asked by the prosecution, why his opinion of FTX changed. And because he had thought it was, a great company. And he said, FTX defrauded all of its customers. And of course, the prosecution said, was something the effect of, we weren't aware that that was going to be his answer. Like, we can strike that from the testimony. But I mean, it was really quite heartfelt when he said it. It appeared to be. And so that was one of the shocking points. I think with respect to Matt Wong, I think he was very, in my view, very well prepared. It was really interesting that they had identified as risks some of the very things that are coming out now about the relationship, the interconnectedness between FTX and Alameda, and that he allegedly had received assurances from SBF and others that that relationship would be moving apart more. Right. And
yeah, there was a whole email that Paradigm sent saying we have concerns about the relationship between Alameda and FTX. And, you know, talked about lack of corporate governance at FTX. There were issues around, whether or not different investors could have a board seat. There wasn't a board. All those kind of like just corporate governance standards were discussed in an email that they showed to the jury.
Yeah. And actually, I wrote down what was in that. Do you want me to read it real quick?
Sure.
Okay, yeah. So what was identified, it said governance, and because it was a bullet point, and it said, as we understand, FTX is effectively owned plus controlled by SAM, lacking more traditional corporate governance model, rights, etc. One example where this can negatively manifest with crypto companies is through, parentheses, unintended value leakage via FTT, Alameda, or some other mechanism. Like you, we place a asterisk, heavy asterisk, emphasis on alignment. As a shareholder, we'd want confidence that the value FTX creates accrues directly to equity holders. We're not suggesting that this isn't the case today, just that candidly, we aren't sure how to think about it yet. So these concerns were raised, and I think it was very compelling that ultimately, I believe it was, how much was the investment? 278 million was the total investment in multiple rounds, and that it is now worth zero. And oh, you know what? Just one other thing about Adam Yedidia for a minute. You know, we heard about, you know, how he had, you know, he received a salary and then he got a bonus, and then he had obviously still a salary, but then he got larger bonus, and he was investing it back into FTX, right? And that then at the end of the day, you know, it's worthless. And now he is teaching high school math. He said that he was teaching 2 sections of geometry, 1 section of algebra, and 1 section of AP statistics. And, you know, I wonder how that hits home with the jury, right? That might be much more relatable. And I think that was drawn out to show, like, this is a person just like you and me, right? Or something, by like contrasting that from the opulence of the condo and things like that. Yeah, I can't wait to
I know,
see what
there's so
happens
much to
next.
discuss. And the last thing that I just have to mention about the condo was the defense, because, you know, he lived in the same luxury apartment with SBF, and I guess there were 8 other roommates aside from those 2. At some point when the defense like mentioned this, because like pictures were shown of, you know, this luxury apartment, it was a penthouse, and the defense said, oh, well, you know, wasn't it kind of like dorm living? And he was like, it was like a dorm in some respects, and not like a dorm in other respects. And then so when the prosecution got to ask questions one more time, then he clarified that it was like a dorm in that you were living with other people, but not like a dorm because it was much nicer than a dorm.
Yeah, he's like, it was much more luxurious than it was in college.
Yeah, it was. I mean, there were actually, you know, in case you can't tell, there were actually a number of moments of levity, at least for those of us in the overflow rooms. There were numerous points where people laughed. So anyway, okay, Josh, this was amazing. Thank you so much. Where can people learn more about you and your work?
You can look on linklaters.com, or you can go to LinkedIn and find me. It's Joshua Ashley Clayman. And I'm also on Twitter at Josh_blockchain. Is it okay if I just say like one little other thing very quick?
Yeah. Go ahead.
There were things that I wonder if it's teasing for later. So we were shown a photo of Sam Bankman-Fried eating, like, and next to him, like, was a woman, and then who wasn't Caroline Ellison, and then next to that was Adam Yedidia. I wonder, we couldn't see exactly or I wasn't paying attention to what he was eating, but I wonder why they showed that, like whether what he's eating comes up, Because interestingly, one of the questions for Adam Yedidia was, do you recall Sam Bankman-Fried sleeping on a beanbag chair? And he was like, well, he used to occasionally nap there, but I don't recall him sleeping with any regularity. So, these little pieces, I think ultimately credibility. And yeah, I think if you can get a chance at home to watch this, those at home, I shouldn't say like at home, to watch this, I think it was really a lot, but really, really compelling today.
Yeah, and just to make clear, the only way you can watch it is if you show up at the courthouse
Exactly.
and you're in. Yeah, yeah. All right. Well, thank you so much for coming on Unchained.
Oh, my pleasure. It's always a pleasure.
It might be something else but it's going to teach you, even if it doesn't teach you what to do, it can teach you what not to do, right? You might realize you're not a swing trader. Maybe your emotions can't handle swing trading. So if you go get a mentorship, but these people don't know. They don't know what kind of trader they're going to be yet. They don't know what kind of education they need yet.
Correct.
So like it's not bad to go through multiple mentors and multiple educators. Just because like we trade very, very differently, but we still make money in the markets, right? They might come to him first and they might say, oh, I don't really like this style of trading because my life is very fast paced. I want to learn swing trading. Okay, so that's for me. Or some people come to me and they're like, well, I don't really like swing trading because I have to sit here and watch the charts and I have to be in certain trades for months at a time. I want the money faster. And they go to him. So there's two different types. So finding the different mentors, that's okay. But I believe in investing in education, and I also believe in not just on the charts, not just in Forex, but overall education, overall financial literacy, like learning how to become financially independent, learning how much money you should save, writing down by notebooks. Like I write down expenses and what I should spend, what I should make, goals, everything along those lines.
I think that kind of comes with just even being a part of the game as well. Like you don't learn everything at one time and then all of a sudden you're good. You learn it along the way. Like a person had messaged me the other day and he was saying something about, can I withdraw $100,000 from so-and-so? And I'm like, but you're not even making $5,000 a month. Like, why are you worried about the $100,000? Like, worry about that when it comes, So, but when that time comes, like you would have learned so much that you'll be comfortable with saying, okay, my withdrawal's ready and I could take out my money. But if you're worrying about something that's all the way down here when you're only like right here, you're stressing yourself out for no reason. So the journey itself, you learn things along the way. So like when that time comes, you're prepped and you're mentally ready for it.
And that's like a big thing that like we want to teach people is that, like you're not there yet, but like give it time and go through the process because like I see so many people, they're focused on like this huge goal, which awesome. Have the huge goal, have that goal, but break it down. Like people be like, I want to make $100,000 in one trade. And it's like, but you haven't made $1,000 in one trade. Break it down. Start with $100 in one trade. Okay, once you hit that, your next goal maybe is $110 a trade. Hit that, maybe your next goal is 150. You hit that, then it's 200. Then all of a sudden you start realizing it starts duplicating faster. So to make your first $1,000 in a trade is a lot harder than going from 10,000 in a trade to 100,000. I believe. Once you get to a point to where you can consistently make $1,000 in a trade, all of a sudden your risk tolerance, your understanding of the markets and everything goes way up. And so it might take you 9 months or 10 months, whatever it may be, a year to make your first $1,000 in a trade. But I think going from 1,000 to 10,000 can happen in a few months.
Because I remember like my first $1,000 day, and I know you remember yours as well. I was walking out of class in college and $1,000 in profit. I felt ecstatic, but I also now remember my multiple $100,000 days now. But the first I had to break past that $1,000 trade first, and then that kind of like opened doors for all those other bigger trades. But it comes in time, and along that way, you learn so much from just analyzing, maintaining trades, all these things that has to be implemented to actually get to that next level. That by the time that you're hitting those $100,000 trades, it's effortless at that point. So but that comes with time though.
And risk tolerance.
Exactly.
Risk tolerance, like what's your ability. Like as you grow, your money grows. Your charts will grow. Like yesterday, I was in a trade, went from up positive 50,000, all within one day. Positive 50,000, negative 50,000, positive 110,000, and I closed it this morning. So like your risk tolerance, people you become acceptable to that. You go from high numbers to low.
Precision on the charts, like what lot sizes that you're comfortable with, like how you're comfortable with the fluctuation of the charts, what sessions you like to trade, if you like to trade news, if you don't, like you got to figure all these things out. It's so many details and everything that comes with this entire thing.
So out of 100 people watching, let's say only 5 take this advice and take time, be patient. What do you have to say for the rest 95? So why would they stop? What do they?
People are hard-headed. Like when it comes down, like like you could tell them the best advice ever. Like from you saying it, you're like, yo, this is some really, really good advice, and I hope you take it in. But a lot of times people just take it in one ear and out the other because they still want to do their own thing. People that do trade, they're very, very hard-headed, but give it time, they'll learn in time. And when they get burnt on the charts for not doing that certain thing, they look back on what you said. Oh, like
either change
it comes with time.
Or they'll quit.
Yeah.
Like I personally do not think trading is like super hard. I mean, it's not super hard.
But that's coming from a person that has been inside it for so long. A brand new person is going to seem complex.
That's what I'm saying though. It's that it takes time.
Yeah.
Like, it just takes time. Like I guarantee you there'd be a lot more successful traders if they said, I'm going to dedicate the next 10 years of my life. If they said, I'm going to dedicate the next 10 years of my life, there would be a lot more successful traders. The problem is people want it in 6 months, and then they don't start making money in 6 months. They do.
I think it's more just about the person just get passionate about it, because even like when I started, I never ever said like I'm going to dedicate 10 years. No, like I just enjoyed it. So why would I stop doing something that I actually enjoy? It so happened to be I enjoyed it so long that I'm going to hit 10 years soon. But initially, like I never said 10 years. Like I say, just find a passion for it and then fall in love with it. And then trust me, you will not stop playing the game, you know. It's a game.
That brings me to the next question. What is it that I could do or should do every day, week or month that will inevitably get me there? So that I don't even have to think about the time. Just in the beginning to start getting the habit and stuff.
Understand that, you know, learning this one skill set can change your entire life. And a lot of times in a short amount of time based on your dedication. But also just be around people that have a similar interest. Make it fun for the people that you're around as well, because they'll also, you know, feed off that energy that you're giving them as well. And just be around a community of traders at times, because you guys would feed off of each other's energy. Like, hey, Tim, like you caught that trade? Yeah, man, like I caught some good money, or I lost money. Like, but it's interesting because you'll actually have these conversations and that kind of thing. So it's a community at that point. It's pretty much a village. And then like as you guys are growing at the same time, and you guys would, you know, help each other if you guys are having a hard time and everything. So that'll actually push you to want to keep on going.
There's two things that I recommend doing. Number one, finding a community. If you don't, like it's not as fun. Like I remember like, we found a community early. I found a community early in my trading career, and it was really just like we would hop on together and we'd drink coffee in the mornings. We'd trade New York session, and it'd be 100 of us, and we'd be shooting the shit. And we'd be laughing because we lost $500. We lost that all. We lost the account. We blew the account.
But it's fun. It was fun. Like it's depressing but fun.
It is. It's depressing, but when you're with other people, like it just makes it more fun. And you start learning. And this person goes and studies this. This person goes and studies this. And then like you start talking to people, bringing people in, and then like you realize like sometimes like I guarantee you, a person that is not even a successful trader, doesn't have to be a successful trader, a person that's been studying Forex for a year knows more than someone that's never heard of Forex. So they can still teach them something. It's cool. Like imagine sitting at the table and you pull up, you know, the trading app, whatever trading app that you're using, you pull it up and, you know, specifically TradeLocker, the community that's behind it, but you pull up your trading app and you go back and you say, oh, like I know something that someone else doesn't know, let me teach them. Like most people don't even know what crypto is and stuff like that, which is crazy to me. Most people don't even know what Forex is too. And like, so introducing it to other people is a really, really cool concept. And you can like, you know, go through everything and show them like, most people don't even know what, you know, Euro USD is.
Yeah.
Which is like.
Just being around the community itself, you know, all these things kind of get thrown at you just naturally. Cryptos came at us naturally as well because we were already involved inside the community itself. And like it never really came like a hard thing, you know, just,
Another thing I would say that's very, very important, chart time.
Yeah.
Minimum.
How much?
Minimum an hour a day. Like absolute minimum. I don't care if you're laying in bed at nighttime like this, just like staring at the chart. You know, going through different currencies, going through maybe stocks, maybe cryptos, maybe the houses, it doesn't matter. Whatever it is, a chart. And eventually your eyes will start to notice patterns. And your brain will be like, I remember when it did this last time. write it down. Oh, I remember when it did this, and all of a sudden your eyes will start to remember things, and you don't realize how powerful your subconscious is, and you'll start to your eyes will start to realize certain patterns and certain movements, and you'll be like, this looks really familiar.
Yeah.
And then that's a huge one for me.
Yeah, and that's what we call studying, because like people used to always ask me like, Q, like what do you mean like when you say studying? I mean, go on the charts and actually try to apply that trend line. See like what happens. See like what you're looking for on the charts, like make something play out. That's pretty much creating that muscle memory. You know, going back and back testing. That's pretty much studying, because you're actually building that muscle memory the entire time. So like when it comes to the charts, like it's effortless to look for a certain pattern or a certain setup because you've been around it so long. Yeah, exactly. It's effortless.
Like it really is. Like I can pull up a chart,
analyze them in 2 minutes.
Yeah.
Yeah.
People ask me how can I trade so many pairs, and it's like I literally like I have every single pair on my list that I watch, and I can literally go through them in 2 to 5 minutes each, 4 different time frames. And it's just because it's muscle memory. I know if I don't see anything in the first 30 seconds, I don't even look at it.
Yeah, it's pretty easy.
So, earning 3K, learning a meaningful skill, something that, and I'm talking now ideally, learning something that you can use in the future is just not a job. It's not a job where you just waste your time. You just learn something that you can use in the future. You got a mentor. You have a community that you're part of. Spending 1 hour
minimum. But also
3 to 5 hours.
not counting how much time you're studying, because I'm pretty sure anything that you guys are passionate about, like beyond trading, you just did it because you loved it until you fell asleep probably. If a person is playing soccer, like they're gonna play soccer until they're exhausted, not just an hour a day and leave and don't touch it again for the rest of the day. Like they're gonna play until they are exhausted. So I feel like just don't really put a time limit on how long to study, but at least put a minimum on it. And if you study for 10 hours, then cool. If you study for 12 hours, then cool. But at least put in an hour a day just so you're actually putting some effort towards it.
Your brain has to be able to
to see it often. Yeah.
Got it. So now we're, let's say, earning a little bit more, losing money, earning money.
Part of it, yeah.
Somehow we got to 10K per month.
Yeah.
Trading and day job.
Okay.
When do you quit your day job?
So like I would probably say like quit your day job when you could actually when your normal life needs more attention than what your job needs, that's when you should leave. Like if you're more busy in your personal life than your job, then quit your job at that point, because now you could actually focus full time on those 24 hours that you have in your daily life. And that means that like all bills are taken care of, like your family's taken care of, like all these things. So at least put enough time in like your personal life to then say, you know what, like I don't need that $2,500 a month because I already have enough money here, but also like my skill set is good enough to at least make that $2,500 that I was making at my job. Then you could pretty much quit your job, but be confident enough to even quit, knowing that your skill set is good enough to at least make up what you're making at your job and money to invest.
Yep. So like this one was a little different for me because I had a lot of people come to me and they're like, I was making 10 grand a month trading while working my job, and then I quit my job and I started losing money, and I was like, that's because the pressure of having to make money was now more intense. You know, when you're more relaxed in the charts. So I personally think you should have maybe 6 months of your bills saved up, and you should make 3 times what your job is. Like that's a little bit of a goal for me. But sometimes I've noticed in societies, people work better when they're forced to work a lot.
Yeah.
Like if you wake up and people don't have as much self motivation, right? And so like when you wake up and you're forced to go do your job, you maybe it's a sales job, maybe you work 6-7 hours a day, whatever, maybe 8 hours a day, and you spend time on the charts in the afternoon. People sometimes do better at that because they're not so focused.
Yeah.
Sometimes when people go switch back to a full-time trader, they start going downhill a little bit. So make sure you have enough money saved, your account's starting up, and you have everything along outlines. That way that you can actually stay organized, and it doesn't matter.
Yeah.
And but I mean, I think you should have all your ducks in a row.
Yeah, and I have a thing called like positive pressure, like positive stress actually. it's like saying add more to your plate, so you pretty much understand how much pressure you got to add on yourself that month to get to that next month. Which means that like if you quit your job and everything, you're trading full time at that point, and your rent now is $3,500 a month. You know that you have to pretty much bust your ass to at least make that, because you do not want to get evicted. And then you have the car payment that's, let's say, $1,200. You have to make at least that to not get your car repossessed. So it's pretty much just like knowing that you have things to take care of. So you have to pretty much focus and apply that skill set and get better on the charts each and every single month, because you have these things to take care of. You have these responsibilities. So it's kind of like a positive pressure knowing that you have things to take care of, and you have to actually meet that quota, at least.
Did you guys have a moment in your life when you were so down, where you thought like, it's enough? This is the last day that this is happening. I'm gonna change everything. And that moment,
yeah,
rite of passage or something.
Yeah, not like no. So like I mean, I had like a bad breakup and that kind of thing, and then that like after that was gone, I pretty much spent at least like a week in my house. I was on the charts every day, just on the couch in the same position. I would have friends leave and come back. I'm in the same position on my laptop. I have friends that could tell you the same thing. I'm just on the computer, just charting for like days and days, like 24 hours a day. I'm barely even sleeping. Like, and whenever I do fall asleep, I'm falling asleep like this, with the laptop on my lap. So after that 1 week, like I pretty much had to break out of like that depression that I was going through. And then I feel like that was like my biggest shift, because, you know, that made me actually apply, you know, myself a bit more into a skill set that I was passionate about, to get to that next level without actually feeling that I have to be down. Like, you know, depression is a choice, I feel like, and you have to pretty much, you know, find happiness in some kind of way, and that's what, you know, changed me.
Yeah. So for me, it was more along the lines of like just growing up where I grew up and stuff like that. Where I grew up, did not want to be like part of that in life. Did not want to be part of like that life that was there. And so I was like, okay, you know what? I'm gonna do whatever it takes. I'm gonna, you know, will do whatever it takes. And that moment of just like watching, like going to a job and working every day for other people, and you know, like working, like yeah, it was fun. I was making my own money. I was young and it was cool, but it was just like, this is not where I want to be. This is not what I want in my life, you know? And that was that moment of like, I'm gonna do whatever it takes to make sure I don't have to do this anymore. And I was young. I think I was like 17 when that happened. And I was young. I started young. I got everything young.
Yeah.
And it came to me really fast at a young age. And like, it was just like, I was over it. I mean, I was even working for my dad.
Yeah.
You know what I mean? Owning part of the business.
Yeah.
With my dad.
What was it?
And at 17, working on cars. And I love cars. I love working on cars. I like working on my cars now.
Yeah.
I think it's fun. You know what I mean? But like, doing something that I thought I loved at the time, which I did love it. It was fun, and I was passionate. It just wasn't satisfying to me.
Yeah.
It wasn't all the way satisfying to me.
Yeah. And I have a thing that I mean, I'm born in Jamaica, so like a lot of the things that I was seeing around like my environment, it wasn't really, you know, too like motivational. You know, like my parents and everything was still like very, very well, but coming to America, like we're seeing a lot of different things now. So I feel like changing like that surrounding that I was in to now a different environment that I'm seeing Lamborghinis drive by, bigger houses, condos, and that kind of thing. And like, why wouldn't I want to, you know, strive for better, you know? Yeah. So I seen more, so I was able to envision more, you know? So me seeing more actually gave me the ability to say like, yo, I love cars, I love this, I love that. Working at a job is not gonna pay for that. Working at a job making $1,200 a month is not gonna pay for that condo that I want, that car that I want, that trip that I want. So finding trading, it gave us the ability to know that like there's no kind of income cap in this industry, and then this can actually, you know, be that that catalyst to actually get you to where you want to be known that you can make as much money as you want to. Like Anthony said, $100,000 in one day, great. You know, that could do a lot for a person. And mind you, that's one day. There's another 365 days, or 364 days, and well, leap year. So leap year. Yeah. So it's kind of like just see more, because then you will probably want more. You know, so like get out there, you know, see more, be in different environments that can actually help motivate you as well. because that'll help you push the limits in what needs to be done to get to that next level as well, and what vehicle you should take to even get to that next level. So trading was definitely that catalyst to actually, like change everything.
And I think trading is it's just a good thing to just know. It's a good skill set to know, because if you can sit back and you can analyze a chart, you can analyze that, you can analyze anything. That's what we are. We're data
stocks,
like
cryptos, commodities.
Analyze companies because we spend every day looking at the chart, making calculating educated decisions on what the future is going to be happening.
Correct.
No one can predict the future, right?
Well, we can, kind of.
Kind of can. And so all of a sudden now, what trading allowed us to become better at is actual business and understanding the business side of things. And he has a positive pressure. I said the same thing. Put yourself in pressure situations, and routine changes. So for him moving to America was a routine change. It changed everything for him. I believe in routine changes. So maybe you trade New York session. Maybe switch it up next week and trade London session.
Got it. Now you're at 10K. What you should not do? What are 5 things?
Don't start to splurge out on buying those luxurious things that you're striving for. Not yet. I feel like that's still the moment that you're still supposed to be grinding. $10,000 a month is still not enough money to actually go on those crazy trips, buy that crazy car, buy that crazy. It's not enough. It might sound like enough, but it's not enough. It runs out very, very quickly. That should pretty much put you in a position to now invest bigger, invest more, start to diversify your portfolio in some kind of way. That's when you could actually start to, get some kind of passive income, some sort of income that pretty much doesn't really have to be dependent on just you the entire time. Start to help invest in other companies, some stocks maybe, that kind of thing. But also mainly invest in a bigger trading account as well, so you can now start to apply a bit more pressure to your account to make a bit more money until that next level.
I would say once you get to 10K a month for, let's say, 3 months in a row, double down. That's when you double down.
So after 3 months, double down on your
everything. You should be doubling down. What got you to 10K is not the same thing that's going to get you to 100K. So double down. Double down. You need to focus harder. You need to focus on your strengths, and you need to start making applying that pressure. And so I would say don't give up. Don't stop. Don't change your routine. That's the big thing I see. Everyone has a goal. They're like, I want to make 10K a month. They make 10K a month for 3 or 4 months. They change
the first. That's the first thing they change is the routine. Actually,
It's why are you changing your life? You just got to where you want to go. And it's and I don't get why people do it. People do it.
Self-sabotage.
It is self-sabotage. I see people all the time. That's something they do. I have so many examples of people being really, really good, being really, really good and really successful at some things, and then they change their routine. And I've literally seen people play tennis, right? And they're getting really good at tennis, and then all of a sudden they're I want to go play racquetball, and they switch this sport up, and it's kind of the same concept, but it's and then they go back to tennis and they're really bad at tennis now because it's something different, right? Why are you don't change it up? Don't change it up. Keep going and double down. Keep going and double down. That's the biggest piece of advice I get is just because you hit your goal, that doesn't mean you should stop.
Yeah, it starts. You actually can learn things along that way to 10K. But you have to learn a lot more to get to that $100,000. Yeah.
So now you're doubling down.
Yeah.
10K, growing.
Yeah, small things, but those small things is going to help you long term, though. Yeah.
Got it. It's the same concept. You're growing from 10K, 50K, 100K. You're saving money. No, it's the same concept.
It's the same concept. They just get
bigger. I feel that. Yeah.
Your account size gets bigger. Your investments gets bigger. Your risk gets bigger. Everything that your mindset. Maybe it's just us. I don't know. But your mindset doesn't change. I wake up hungry every day to create business, to make more money, to do more things. So it's very, very hard for that, to change. But I would say it doesn't really change. You don't change as much as you say you can do. You don't. But you're still gonna wake up with that little bit of fear. You're still gonna wake up with that eager. You're still gonna wake up with wanting to do more.
Yeah, hunger.
You're gonna want to keep going. That hunger, it doesn't go away.
It's still fresh. The 100, I feel like.
No, hunger or 100?
Hunger.
The hunger. Like I said, yeah,
Positive
the positive pressure and the passion, you know, and then also meeting people along the way. Make sure that you're networking along the way as well, because there's certain things that you know that a person doesn't know. Like when I met Anthony, like I was doing good, but at the same time, like just getting that connection made things just blossom even more, because now we're applying his skill, we're applying my skill to now just, you know, using like in unity to then build a bigger business and that kind of thing.
You guys met much earlier?
When?
What if you guys met much earlier?
We met. I was young when we met.
Yeah, I know.
I was young. Was I even 21?
Damn, where are you? Oh,
So you know
19.
each other for a while, right?
Yeah. We've been business partners for 6,
Probably,
7 years.
If we met earlier, so
It'd be the same thing.
yeah, that. But I do believe in God's time. You know, I believe that all timing is the right time, and the fact that we met at a certain time, he was on his stuff, I'm on my stuff, and then it was like the perfect time to then, you know, make that collaboration. If it was before that, I would have probably not been ready enough mentally. But who's to say? You know, it's already happened. So yeah.
But guess what? It happened. And now we're building some of the biggest businesses in the
Because I'm not really big on hypotheticals. I'm not really big on hypotheticals because what's real is real. So you know, we can't really go back in time and everything else. So hypothetically
One
is.
guy that I want to meet. He's talking about synchronicity, and he spoke to probably every single interesting people in the world just doing these interviews. And
yeah, I have an interview with him like next week actually.
Yeah, this is one Croatian guy. I'm from Croatia, but there are not many people who talk to internationals. And I don't live in Croatia for a long time now. But if there was one person that I want to meet, it's this guy. So he interviews all these, you know, conspiracy theories that people who believe in, you know, whatever, strange things, that businessmen, everybody. And he spoke about synchronicity. And then if you look like 10 years before or whatever, you look at your life, could it be anyhow else as it is right now, right?
Yeah.
Can it be
different?
Different. And you look at every single point of decision that you made,
to lead up to that point.
To lead up to that point.
Yeah,
and you're thinking now, would you do something different? Probably.
It's crazy because I thought about that once and I'm like, okay, if certain things didn't happen, I'm pretty sure I would have still met Anthony because I was already, you know, on that certain path and he was already on that certain path. So like we were like this, and eventually, you know.
And your reach.
Yeah, like exactly. And then we would have still noticed each other in some kind of way to then have that conversation because he's very, very vocal. So like he'll actually reach out immediately and that kind of stuff, and then that would have started the conversation. So like that would have happened regardless. I feel like timing wise, probably a little bit different, but yeah, like I mean, I do believe in God's timing, and I do believe that everything does happen for a reason, and that you meet every single person for a reason, and that things that are forced doesn't really last. Yeah.
And at the end of the day, like it's hard for me to answer that question because I don't really think there's anything I would actually change about my life.
Yeah.
So like, even if like I legitimately like, there's not a single thing I change about my life. I literally
it played out perfect in your own head.
I can't think of anything that. I mean, maybe
so,
a bigger.
To say to even to like.
There's nothing I would say that I could really honestly change.
I believe this. Like, if you said that you have to change anything, that if anything was a little bit different, then that means that you're not showing gratitude,
exactly.
and that you're not like grateful for what happened, how it happened.
What we have.
If anything changed, or if you said that you wanted to change anything, that would have said that you're ungrateful.
Maybe.
You know, if you wanted more, yeah, true, like that, right?
I could go a little longer beard or something. You know what I mean?
I think everything happened perfectly. You know, as perfect as it could have been, and it's still going. So yeah, we're still growing.
At what point do you buy your mom a car or a property?
So I mean, so put it this way. Like I remember this one time, like my sister had my phone actually, and then like my bank account had popped up. It said about like $9,000, and then at that point, like they were upset that I wasn't paying more bills. And I'm like, yo, listen, it's not time yet. It's not time yet. Until, you know, years later, I'm at where I'm at now. Now I could actually spend that $30,000, $40,000, $80,000, $110,000 on a vehicle that they want and not feel it. Back then, I feel like there was a time that if I did, I'll be doing it out of just being, desperate and hurting myself. You know, it comes to a point that like if I'm able to actually spend that, I have to not feel it. So you buy your parents a car or a house and that kind of stuff at a point when you could take that money out of the equation and not feel it. And when I say like buying a car, I don't mean payments. Pay it off. House, pay it off. Like just get things that they don't have to stress about. Because if you buy a person a car, but they got to make the payments or payments are being made, now it's a bill. Now it's stress. Buy it to a point that you could actually take that money out of the equation and it's not a stress to you, but all is beneficial to them and they don't have to stress about it. Insurance is paid for, everything's paid for, and then they just have it. So I feel like if you could pretty much just spend that extra 50K or 100K, you have to not feel it to make it comfortable to actually spend that money on a car. Yeah, or any type of gift to a family member. You can't feel it because if you do, then it's not time yet.
Got it.
Yeah.
At what point did these interesting deals start coming to you?
It comes when you start to it's not even about the money, it's about more just your ability to network and have conversations to then have those deals and that kind of thing come to you. You can make that $1 million a month and no one knows you. But if you're a person that is making that $1 million a month, but you're also super social, like Anthony's super social, so like deals just come to him. He'll go to a bar and all of a sudden, hey, like I'm an owner of this company. Great. But it comes with personality. It comes with just being able to network, have conversations, and just being a person that's a bit more open to going outside and interacting with other people, despite how much money that you're making. Because if you're a person that just makes money, but doesn't actually network with anyone, no one's gonna give you deals.
It's boring.
And it's boring. No, but no one's gonna ever approach you with a deal or opportunity because they don't know you. You know?
Don't be a weirdo.
Yeah, don't be a weirdo.
Don't be a weirdo. But no, like when it comes to buying stuff for other people and gifts and like when you can actually do stuff like that, it's really cool. And it's really powerful. But the number one thing that I can't stress enough is take care of yourself first.
Always.
Like I see too many people spread so thin because they're trying to take care of everyone else. And like you realize that if someone is trying to take care of everyone else, it doesn't work. The system doesn't work. That system does not work. Taking care of everyone else at the same time you're taking care of yourself. Build yourself up first, and then naturally they'll all grow with you.
Yeah.
Because they're gonna be forced to grow with you. And so like build yourself up first. Like make sure you're set, because if you're not doing that, then you're gonna spread yourself so thin to where you can't grow. You're capping your growth. Yeah. You're letting people around you cap your growth.
Yeah. Because I have a thing that I say like if I'm building a house out of bricks, how can I give you bricks when I'm trying to build my own house? If that's the rate, then I'm never gonna have a house because I'm giving my bricks away while I'm trying to build my house out of bricks. Yeah. It doesn't make sense. So like, let me build my house first, and then when that's completed, then I can give you my bricks and not feel affected.
Yep. And so and that's like a huge thing. And then people always are trying to like grab things from you and stuff like that, and they're like trying to grab money, or they're trying to grab this, they're trying to grab that, and you just gotta be like, no, don't be the nice guy. Don't be the people pleaser. It doesn't work. Just
how do you protect yourself in those situations?
I mean, stay kind of private. I believe in stay private, but just don't be afraid to say no.
Don't ever say no.
Like
practice.
It's okay. Yeah.
Look in the mirror and to say no. Like just practice.
Yeah.
Because it's definitely the hardest thing, because you don't want to say no to a person that you actually care about.
Yeah.
But you also gotta respect yourself enough to say no.
Yeah.
You know?
And like, I mean, I believe in like the theory of always saying yes to an extent, sometimes.
Yeah.
But that's because people will take advantage of you.
Yeah.
Just always say yes. So don't allow that. So like, practice being able to say no to people. Like, I know it sucks right now, but like, say, hey, like, there's a bigger picture here. There's a bigger vision. If I'm trying to buy a company for, let's say the company costs $1 million, but someone else needs 900,000, like, or even 100,000, and I can't buy that company. They could potentially make more money, so I can give them more than they need. You know what I mean?
Yeah.
Like focus on yourself and build your company and stuff like that. And I'm not saying, I'm a big believer in giving back. You give back. You always give back.
Yeah.
Everything that you do, you give back. You give back. You give back. You give back. Make sure you're doing that.
Yeah.
And then just putting yourself out there, like when it comes to finding deals or companies to invest in and partnerships, put yourself out there, and don't be afraid. Like that's something that we said earlier. Double down, right? The investments just get bigger.
Yeah.
We're doing the same thing we were doing 5-6 years ago. Just the investments were $10,000 and $5,000 to $10,000.
And now we're talking about deals that are like $1 million to invest in that time, $3 million at times.
We're buying parts of major companies now that are publicly traded, like well-known companies. And so it just starts becoming double down on the same thing. Investments get bigger, risk gets bigger, but your money gets bigger.
I love it. You said you protect yourself by being more private. How do you guys protect yourself?
I mean, I never ever talk about income. Well, I show what I show, cool, whatever. But I never ever talk about personal finances. I never ever get into details about personal finances. Like whatever they see, then they could assume whatever. So I never ever, go too in detail with that. Nor do I, I mean, that's pretty much the biggest thing. So not talking too much and learning how to say no. And don't feel as if like you have to answer every single question, Yeah.
People can have assumptions all they want about what you make, what you do, and all that. And honestly, at the end of the day, like let people talk, because I just grow with their network anyways. If people are sitting there, hey, no need to sit there and grow your network. People are loving with like having fun, sharing stuff with you. It's gonna grow your network. You know what I mean? So I will say that's a very, very positive thing.
Yeah.
And just being smart. Simply just protecting yourself by being smart. Like there's little things like that we do. I mean, it won't matter right now, but we're in Malta. We don't post we're in Malta. You know what I mean? We don't put that out there, right? We post somewhere I post somewhere in Europe.
Somewhere in Europe.
I post somewhere in Europe. Like literally everything is somewhere in Europe. Or if I'm here or waiting to post for certain different things. And so it's just protecting yourself in all kinds of aspects. Just being conscious of what there are people that like want.
It's weirdos. There are weirdos out there. But it comes with the territory. But at the end of the day, like we spread so much positivity that we've never ever encountered a person that was super weird. But you never know. It's 7 billion people out here. You never know sometimes.
Yeah.
And how did being huge on social media, or when did your deals start coming to you because of social media at one point?
I think it was more just people seeing how we move on a daily basis, how we actually move as as a person. It could be just business that we're growing. Things that we're investing in as far as like just our efforts on the charts, how passionate that we are about the charts, the people that we're around. People seeing that alone, I feel like that makes them a bit more comfortable with trying to reach out and get some sort of conversation to get a deal and that kind of thing. But just more, just like kind of like showing what we're all about as a person in business, like all these things. And then, people start to reach out at that point.
Being authentic.
Yeah.
Just being authentic.
Simple. Yeah.
I mean, I'll be sitting there and drinking a cup of coffee, and it's like I'll post a picture of the coffee. You know what I mean? Like it's little stuff like where people can relate to you, because people want to be relatable. They want you to be relatable. Where people can relate. Oh, he drinks his coffee with cream for some reason. I
do
don't know.
too. Or
I do too. Like, that's cool.
Pineapple on pizza. That's always a thing. that's always a thing.
I don't like pineapple on pizza.
I love it.
But he likes it. You know what I mean? So but I think like the biggest thing as far as social media and making the deals happen through social media is showing your life being authentic. I went through a phase like a while back where I thought everything that I posted had to be perfect, and it really like screwed everything up.
Yeah.
It didn't screw everything up. It was just a learning phase for me, right? Like now realizing like it doesn't matter. Like if I hold the camera like this or like it doesn't have to be perfect. Having fun with it and being real.
Like you don't have to have an 8K camera to take a photo and then expect the best engagement off of that one photo. When you can take a regular right concept. It's just more about just be in the moment, and not everything has to be like that picture perfect type thing, because at the end of the day, like it's more about just trying to be relatable and engaging with the audience as much as possible as well.
And when does a new trader, the one that's watching this whole journey, when should they start posting on social media?
Immediately. Because so like I have now 4,300 and something photos on my Instagram, right? It shows when I was back in college, when I was working at Target, when I left Target, when I had like my first day after leaving my job, and when that journey started at that point. When I was making $100 trades, and then when I was making $10,000 trades, and when I was making $100,000 trades, and then like my biggest day, $400,000. Like, so they seen everything from the ground up. So it's a lot more relatable knowing that they could go all the way back to the point one and then say, you know what? he was there also, versus just posting 6 photos of you living lavish the entire time. So I say just use Instagram as you documenting your life versus only showing your highlights.
And like, not to mention, like, back to, like, you can help other people experience and learn this industry too, even if you're not like extremely successful in it yet. Start showing what you're looking at and then get feedback. Like, I can't tell you how many times people send me pictures or they post pictures of like, hey, what do you think about this chart, Mario? And I'll be like, well, personally, it doesn't work for me, but it could work out for you. I don't really know. As of right now, like, I'm still biased short on this. You know what I mean? Because of this. And then all of a sudden people are like, oh, wow, you're actually talking about your learning. Like, you're teaching me. And so it's like, by people reaching out to us and tagging us and bringing us aware to their page, we're going to help bring awareness to them as well. And we're going to teach them the way, because there's nothing more than that Q and I like to do other than helping teaching people. Like it's fun because like it's different. Like now it's routine for us, right? And so now it's not gonna say it's super easy, but it's easy for us, right? We know what we're looking for. We know what we want. We know what we need to do. We know how to do it, right? It's simple. But for us to go back in time almost and talking to people and not realizing that they don't even know what a pip is or something like that, it's like it's cool. It's cool for us to do that.
Yeah. Like we love knowing that a person is still trying, yeah, but also like a person that is just getting that passion for the craft, knowing that we've been had the passion for the craft. We're open to actually giving that extra knowledge to help push them a little bit more, you know?
You know what would be cool to do?
What's that?
Maybe we can do a trade locker or something like that.
Yeah.
Setting up groups of 5 people, like a small group where they could connect it to similar or different people, doesn't matter, we'll figure it out. But 5 people, different groups, and you get 5, 5, 5, 5, some kind of bot that tells them, hey, did you do this today? Did you do that? And it's all private, they check with it, they give the stats, it goes somewhere in the database, and every week, after a week, it shows in a group chat for all those 5 people how much they fucked up, what did they do, what they didn't.
It kind of shows accountability also.
Yeah, so they can be friends, they can be some random people. I had this idea in the beginning of 2020, when all this coaching industry was,
skyrocketing,
going through the roof. No one had a software that can actually, because that's what they pay, accountability. People pay for accountability. Yeah. What if all of them were successful? They don't know each other. You connect them in the same group. Now they have accountability bodies, but they also network. They also know that if they mess it up, it will be posted publicly. And it can be a product, it can be something like subscription, whatever. But it connects like a lot of dots together. Very smart.
I like it. The fact that, you know, you're kind of like forcing people to have those people that have the same interest versus them having to find it.
And it keeps you out of their, back all the time. As a coach, they have accountability groups where they already are pushing each other.
Yeah.
You don't need to tell them all the time.
Correct.
Tell them, hey, how's it going? Whatever.
Yeah.
They already know.
Yeah. I think it's more like an iron sharpen iron type thing. You know, it's going to be a bunch of people that pretty much understand that they all have to be accountability for everyone completing everything every single week. And then when that survey comes in to make sure everyone has done everything, you know, you could actually, help that person that probably slacked, and then that next week and so on and so on. Like they could actually help each other.
Yeah. That's a big thing that Q and I have is like we hold each other accountable. Like, we do it in like sometimes competition ways. Like yesterday we were in 2 different trades and we're like sitting here like throwing jabs at each other and like having fun with it. But we're accountability partners. Like my goal is to hit a certain trade number before him. Not because I want to see him hit it. I want to see him hit it, but we're accountability partners and we like to talk shit to each other and have fun with it. But like we're friendly competition because when.
But what did we say earlier? Positive pressure. It's positive pressure. You know, I want to see him grow, and he wants to see me grow. Like we want to see each other grow, but we're also applying that extra pressure as well, just to make sure that we are growing in some.
We're forcing each other to grow.
Correct. So like those teams, you're forcing people to grow. Same concept, just a bigger group. Yeah.
I wanted to ask you guys, what is it that you want to talk about but no one ever asked you?
Damn, I feel like I've been asked so many things. It's kind of hard to say honestly, but I think it's just more probably one thing I'll probably say don't be afraid to start a business and like post on social media and that kind of stuff, not caring what anybody thinks. Like I think people overthink a lot of things before they actually post a picture or something or get into something new. Like they overthink it to the point that they don't do it anymore. You know. So I feel like just whatever you're into, just strive for it. Like don't really care what other people think about it. You know, like when you start only doing things just for people acceptance, like that's when you stop living. I feel like, you know.
Yeah.
So just like do things that you're actually interested in. It could be trading. It could be actual trading, like the business side of trading. It's up to you. Whatever. Just try to actually find a passion for that certain thing and strive for it. And don't care what the feedback is because you're doing it because of you.
Yeah. And the people that are crazy enough to think they can change the world typically are the crazy ones that do.
Yep.
You know what I mean? So
at least they're trying.
Yeah, but for us, like something that I want to share is like we're no one's competitions. Like we're not competing. We don't want a competition. We're here to grow and have fun and build. Like that's something that I love talking about. Is because we're not anyone's competition. We're not any other company's competition. We're nothing like that. We don't believe in competing. We don't believe in it. We're in our lane. We're going to build our own lane. And if we have to build the damn road, we'll build the road. Whatever we have to do. And people can join us. People can join with us. People can have fun with us, and we can grow. But we're no one's competition.
Yeah.
We're not in competition with anybody.
Because I had posted something this morning actually. I had said it's when coming into an industry, it's always as far as it's this company and this company. It's not this company or this company. Yeah. Like that's probably the biggest thing. Yeah. People always think it's just this company or this company versus saying, oh, it's this company and this company. It could be in this like one space. It's perfectly fine. Yeah. But whenever it comes to like people saying or thing, they feel like it's like a battle every single time. You don't have to choose sides. You could choose both. Yeah. And enjoy both at the same time. So just understanding that aspect of things that you could actually be in an environment where there's two great companies. There's two great people. It doesn't have to be a battle.
Yeah. I saw the post on Trey Locker when we were reposting it.
Yeah. Like it was a very, very important thing because I feel like that's something that's definitely overlooked. Yeah. And people don't think like that because they always want to see. It's kind of like I've never seen it, but back in the days in Rome in the Colosseum, like people want to see a fight. They never ever want to be in the fight, but they would rather sit back and watch a fight, because they want to see these two companies go at it versus understand.
Like this,
yeah.
Yeah. I mean, like it's just better that way. There's more money to be made. Number one, there's more excitement. It's more fun.
And it's not even about the money. It's not even about the money. It's about just the impact. It's about the impact.
It's like how many directions can it go when you two powers collide, or
exactly.
go together.
Yeah.
And that's something that's really been heavy, I guess, with us lately. It's like the competition. Like we're not here to compete. We're here to grow. We're here to grow, and we're here to build. That's simply it.
Got it. I have a few more quick questions.
Okay. Keep it quick.
All right. One book you would give as a gift if you had to give one book as a gift for the rest of your life.
I'll probably say the 50 Laws of Power.
Which one?
What's it? 48 Laws of Power.
48 Laws of Power.
I just started to read it about a couple days ago now. And yeah, I'm on just I think the third law, and it's just life changing because it's so much insight there, and the fact that there's so much information in one book, I think is just beneficial because it teaches you how to think a little bit different, how to actually just deal with the situation a little bit different as well, and compared to a lot of the other things, I feel like this book is more just like a life benefit versus just a skill type of benefit. It's benefiting you as a person, how you think, how you act, how you move, and all that. So that's pretty much one book that I would definitely recommend.
And my journey of.
Do you have it? If you can think about it.
My favorite, I would say my favorite failure would be not becoming as successful as a trader faster, as fast as I wanted it to be. Mm-hmm. It taught me resilience. It taught me passion. It taught me how to really work. Most people want to become successful in a year of trading. It took me 5. took me 5 years to start making money, and it took me 2 years after 5 years to like make life-changing money. So I would say that's my favorite. That'd be the best failure I've had because it taught me a lot.
Okay, so like my favorite failure, I would have to say that I'm glad and I appreciate my college program not getting me into the program. because that would have changed so much, I feel like, because I was actually going to college for nursing. Very, very different from what I do now. But I did all my prerequisites. I did everything that I was supposed to do, but I just didn't get into the program. And if I did, I would actually stop, trying to build my business, stop trading as much. I would have stopped pretty much everything because I would have been so just like overwhelmed with all the work and that kind of stuff that it took to actually get into like that industry at the time. So me not doing that, it made me focus full time on what I was currently doing, which was trading, teaching, all these other things to get me to where I am today. Because if it didn't happen that way, then I would have still been probably in nursing school and that kind of thing, Yeah.
Got it. 2 more questions. What is one bad recommendation that you hear in the industry constantly that you don't agree with? And if you could have one recommendation that you think is right, that you would put on the billboard for everybody to see in the world, for all 7-8 billion people, what would it be?
What was the first part again?
What's a bad recommendation in the industry?
A bad recommendation?
And it's just repeating, yeah.
I think probably the worst recommendation is how do I say that?
I know what you're about to say.
Oh God.
Don't say that.
I won't say that. I think probably the second one, I'll probably say people are afraid to invest in other people. As far as invest into a person that has what you want. So like where you're trying to go, there's a person that's already there, but they don't want to invest inside that person because it's that person. Like they don't want to give money to a person to invest inside the knowledge that they have, the course that they have, because it's that person. It's like they would help a business or not help a business knowing it's that person own a business, So that's probably the wackest thing. And it happens so often versus just understanding that business is good. That person is good. Why not get their knowledge and not being scared to actually spend money on something that you actually want as well? Because the fact that a person would rather lose all this money versus just investing in something to not make them lose all this money is crazy to me. Because versus spending, let's say, $700 on a class, they would rather lose $4,000 in the markets before they invest. so it's definitely working backwards, but they're open to investing into a professor at a college that they don't know for information that can't make them money. How does that make sense? So I would probably say just, that's probably like one bad recommendation that I hear very, very often. Oh, just go on YouTube. It's all free. Good luck. Those people that's on YouTube is not making the kind of money that you could make with an organized platform and an organized course set up from A to Z versus G, X, X, B. But it's like, that's YouTube. YouTube is scattered. So you got to pretty much find information in a scattered way. And that's not going to really benefit you long term versus investing in something, regardless of who owns that, and getting that knowledge and using it to your benefit.
And I know I said earlier, I said start on YouTube, but what I mean by it, so clarification, when I say start on YouTube, I mean like learn how to use like apps, learn like what a pip is, learn
basic
spreads,
stuff.
like basic stuff. You know what I mean? Like there's a ton of stuff, but like when you actually want to learn how to like trade, like learn from a mentor.
Yeah, so like
Honestly, I don't teach people what a pip is. You know what I mean? I don't teach people why the spread is, what the base pair is. You know what I mean? I don't really teach that because I feel like
you can learn
that
terminology and that kind of stuff. Yeah.
Like a simple search. You know what I mean? So like that's what I believe.
But strategy and that kind of stuff, okay, cool. Then now you got to invest. You can learn like the more basic stuff, like what is Fibonacci? What is this? What is that? But how to use it all together in a style, you have to invest inside that. So either you're going on YouTube just to get clarification on what is what, but to actually get like a skill set, an actual style, it costs money to invest inside that at times. Because YouTube is not going to give you a trading style.
And what's the one thing that you would put on a billboard for everybody to see if you could make it?
I would probably say
Again, it's not
I'll probably say like my famous quote that I always say, believe you're great before anybody else does. Because believing that you're great before anybody else does is major, because you're starting something knowing that you have the capability to actually to be great in a certain field versus whenever you're now great, now everyone's telling you that you're great. So believing that you're great before you even get to the point that you are actually great, you know, because that's giving you the confidence and like what you need to even strive for that greatness first. So you don't have to wait for people to actually praise you. They'll praise you eventually, you know? So it's believing that you're great before anybody else does, because, you know, you got to have that confidence of going into a field so you could actually strive to be the best. Yeah.
My thing that I would say that I don't like about the industry, like a quote or something like this, is that trading is basically that trading. How do you say this? That trading is the end all be all. I see people come in the industry and they try and sell something in the trading space. Like, oh, in 1 year you can change your entire life. And I'm not gonna say your life's not gonna change in 1 year. I'm not saying that one bit.
Very possible, but yeah.
It's very possible. What I'm saying is that doesn't mean it's the end all be all. It's not the end all be all. It's just trading. Like it's okay. Like, have fun with trading, have all that. But like it doesn't need to be the end all be all right away. Like there's too many people trying to sell the dream, and it scares people so much that they end up quitting so early when they don't hit that goal.
Yeah.
Like, I've seen people literally tell people, oh, if you start trading now in 6 months, you can quit your job and have a full-time income and do all this stuff. And then they don't have it. Then they go, well, I'm not meant for this then, obviously.
Yeah.
If other people are doing it in 6 months, then I'm not meant for it. No, and that's the biggest like misconception of the industry, and I hate that. I hate that stigma over us. And then speaking specifically in trading, what I would want to put on a billboard would be let trading complement your life. Don't make it your life. So like I teach people a lot of times, you know, your first goal should be make trading pay your phone bill every month.
At least that.
At least that. And then your second goal, maybe make it pay your phone bill and your car note.
Yeah.
And then make it pay for your gas and your car note and your phone bill.
Yeah.
Then make it pay for this bill. And then all of a sudden when trading starts paying for all these bills, you can then realize. So like don't you know what I mean? Make trading complement your life at first, and then it will come to be everything that you need.
Awesome.
Yeah.
Yep.
Thank you guys.
Absolutely. I love it.
I love it.
Yep.
Come through 2 lines and that, no cold talk, I don't do mine like